Hi investors, welcome to SOIC. And let's just welcome Rohit sir, and let's just write welcome to Rohit sir in the chat section below. Let's just drop a welcome in the chat section below. So Rohit sir is joining us from US, and he's an investor who has had an experience of more than 25 years in equity markets. And I'll admit that I've learned a lot more things from him. And I've been actively tracking him ever since I actually started investing, because one of my own mentors like Ashish Kila actually suggested me to be a part of the advisory as well. So I've been I've been one, since 2016 or 17 I've been a part of RC Capital, and I think I've learned a lot. Stock ideas are very secondary for me, but just the entire process of the probabilistic based thinking, which people have to think about, is something we have to actually instill in ourselves. क्योंकि हम फंडामेंटल इन्वेस्टिंग कर रहे हैं, अगर हम टेक्निकल एनालिसिस या कुछ भी यूज कर रहे हैं, at the end we are doing nothing but we are trying to play the probabilities. At the end it's a probabilistic art, right? And that is how we have to think about it. And it's actually a privilege to host Rohit sir, because he's this is the first time we are hosting him. So hope we keep doing such presentations together for a long period of time again and again.
Hi Ishmat, do you want me to get started, or you want to wait? I mean, I think I'm a little early.
No, sir. So, we can start already. Most of the tribe members are already here.
Okay, let me share my screen. I know I'm not on video. Sorry about that.
No worries, sir. And we can actually start in 5-10 minutes. We can have a conversation, because some other tribe members might join at 6 p.m. They might not have been able to attend.
Okay. And anyway, I'm also trying to get my presentation and everything set up in in Zoom. So yeah, if anybody has any questions, we can start with that, or we can have any other conversation which you have in mind. That's also fine. But hello everyone. I mean, it's a real pleasure to be talking to all of you. This is the first time and hopefully not the last time. So yeah.
Right, sir. And
go ahead, Ishmael.
Anyone has any questions, so we can just have a round of question and answer. I'll just introduce Rohit sir. So Mr. Rohit Chauhan has an investing experience of more than 25 years. He's an engineer from background. And I think he started his blog. So what was the name of the blog which was initially there?
It used to be on Blogspot. This is to be a free thing for from Google. So it's valueinvestorindia.blogspot.com. I have moved it to valueinvestorindia.com. So yeah, that's what it is. Been there for some time.
Yeah, it was one of the earliest value investing blogs, which was there in the Indian investing context, if I must say. Because in 2014 or 15, if you just search about value investing blogs in India, either you'll find Rohit sir's blog or you'll find something on Value Picker. But apart from that, it was very difficult to find literature on value investing in India. So I'll actually highly suggest each and every one of you to also go through his blog and read some of his articles as well. And apart from that, currently he runs RC Capital, and at RC Capital he has an advisory. And sir, RC Capital was started in exactly which year?
This was started in. So I'm covering this partly in my presentation also. It has a very interesting history for if others need to know. So after, when I was writing the blog, so this is 2011, right? SEBI did not have any regulations around sharing research, around talking about any of whatever you are picking, and so it was pretty much a wild west, right? Anybody could say anything, do anything. I used to publish research on my own. There would never be any recommendations to buy or sell or anything of that sort. I was never interested in anything of that sort. So I used to publish my research. I would publish my portfolio, entire portfolio, my returns, etc., etc. And then some people started asking, why don't you start some surveys? And my first question was, you have not met me, you have not seen me. Why would you want to give me money to manage your money, right? Like, I mean, on an unknown person, not seen on the internet, why would you want to do that? So then I just put a message out saying, I'm going to start this. Are you interested? You can go ahead and, you can just send me an email. So I got a fairly big response to that. and that's how it got started. But again, there was no, no regulations around it. So it got started around in 2011. And then when the regulations came, that's when I formed the partnership and then the whole company and everything around that. So yeah, this was pre SEBI regulations and everything. But I think it's a good thing now we have regulations and everything because it protects the investor.
Right.
Often it is more than what you would expect, but I think it's a good this thing to make the market safe for everyone. It works for everyone. So yeah, that's how it got started, unexpectedly. I never any plans of starting it. It just let and as it happens for most of us, right? One thing leads to another, and kind of land up over there.
Right. And I think it's been more than a decade since RC Capital has been running, and
Right. Around 10, 11 years now.
right.
It's a nice little side project, right? Which keeps going on and on. So yeah, just keep doing it.
Look, one of the subscribers is in the RC Capital subscribers in the chat section. He has a
Yeah.
Hemang Shah, so he's I've been a subscriber to RC Capital for more than 5 years. I can attest to what Ishmoit has said about Rohit sir. Question: what have you changed about your what have you changed your mind on in the last 5 years?
Oh, I've covered that in the presentation.
Right.
Let me not change that.
Let's not break the suspense.
Yeah,
Right.
and if you're not changing your mind, you can be assured that you'll fall back in the markets. So you have to constantly keep changing your mind because the market is changing anyway, right? So I think all of you, thanks to all the presentations which Mohit is sharing, you get a sense that things are markets are constantly adapting, right? So if you are not adapting yourself, then you're falling behind, right? So we'll cover that. And I think there are I'm just looking at a lot of questions. Somebody has asked me about poker. How has poker affected your decision making? Good question. I have a slide for that. Then
So I think we should
yeah.
actually start with the presentation. Then we'll do the round of questions. I think.
And correct. So I mean, Ishmael, I'll maybe we can do Q&A in between. It's not a this again. I think we spoke, right. This is not a structured. I mean, it's a presentation, but it is not about any industry analysis or company analysis because obviously nothing can beat what you are doing. And it's a lot of effort and a lot of work goes into what you present. So I've not done any of that, right? There is enough content for your subscribers to go through that. So this is more in terms of going through the journey of what I've done for the last 25 years. It's almost 25 years since I started investing. So we'll go through that, right? And if there are questions in between, feel free to interrupt me. I mean, this is just
if you want to ask any question to the audience, if you want to stop for questions, so I'll just put my camera back on at that time, and I'll just ask the audience. Okay, sir. So I'll just turn the chat box off. You can share the presentation, sir.
Let me do that. And apologies again for for not having the video. So I've titled my presentation as Journey of an Accidental Investor, and I'll talk about it. Why I think of myself as an accidental investor. We'll just start with the usual disclaimers. I've brought up, or I've covered a lot of stocks in this presentation, and they are all for example purpose. Why they are for example purpose? Because some of them are, let's say, from from before 2000, and a lot of you folks are very young folks, so that obviously shows my age also. There are not even charts available for those stocks, and some of the stocks are not even listed. So obviously it kind of just follows through that these are for educational purpose. Even if you try to find a stock called SSI, you will not find that stock in the stock market, right? So again, it doesn't matter whether the stock is from 2000 or the stock is from 2020, right? In the end, you will realize that mistakes are almost universal and they happen across time and age. And it doesn't matter whether it was in the past or it happened in 2020, where a lot of people became very optimistic about technology stocks in the US. You'll find or you will see the echo of that in 2000. So a lot of things in the stock markets are are just a repeat. So let me start with my background. How did I get all started, right? Again, background as Ishmoit shared with you, right? was an engineer, was doing my MBA. My father passed away when I was doing an MBA, and that's when the responsibility to manage the finances for my family kind of fell upon me. So I think you'll see a thread in your life, or you may have already seen that, and as you keep progressing through, what you will see is that uh, we talk about investing as quantitative, this formula, that formula, this approach, that approach, all kinds of stuff. But in the end, you have to realize that investing is very personal, and it is very much shaped by your own personal experiences, right? Somebody who goes through uh, you know uh, financially constrained experiences will invest in a very different way from somebody who has not gone down the same path. So saying that my approach is right, your approach is wrong, or do it this way or that way, it's, if you will realize that it's not very, it doesn't make any sense anyway, right? Because how you would approach investing would be very, very dependent on what your experiences are, and your experiences can be personal experiences, country, time, family, where you kind of grew up. So that's the reason why I bring this up, right? My own investing, which is quite cautious and risk averse, is based on the experiences which I have gone through in the past and the era in which I grew up, right? So again, had a very strong desire to be financially independent based on the experiences during this time. I always like to read, and I think that's a common theme I see among almost all investors, right? And investing turned out to be a very fun way to do it, right? Like you keep reading, you keep just figuring out stuff, and you get paid for it, right? Like what can be more fun, right? While you're doing something which interests you, you're also making money out of it, right? So that's how it all got started. I was always a very avid reader till that time, and I just kept reading. So I started learning the basics, right? When I started doing this, I had no clue about, I mean, yeah, I had a few courses in finance in the MBA, but I mean, if you're not really interested, you just try to pass it, right? But so then I started really diving deep into the basics, right? Okay, what is a fixed deposit? What is an insurance? What is a stock, etc., etc. And just kept exploring. And then one of the days, I started working at that time. I was with Asian Paints at that time, interestingly, right? One of the compounders, the companies, and the company, believe me, I can talk about it also, but it is really a very good company. But anyway, I was working with them, and I walk into a bookstore, and this is very early in the internet days, and I see this book, right? I've shown you the picture also, and I picked this up because it talks about the greatest investor who was one of the richest man even then, and I start reading about it, and then it just hits me that here is this person who, just by reading and just analyzing companies, which is what I was trying to do, had become one of the richest man in the world, right? So I know it, at that time it just felt like something magical. It's not as easy as that, but at least so somebody was just starting off this. Ishmael, can you hear me?
Yeah, sir, you're audible.
Okay, I thought I got disconnected. So okay, yeah. So yeah, so I just read this book, and it just hit me that this is, after so many years I can still remember, there are these moments in life, right? And that's why I call myself as an accidental investor, right? There was no grand plan of big, of investing for the next 20 years, of becoming a value investor. And you're talking of this in late 90s, where there was no I mean, there was internet obviously, but there was no value investing community. There was no material. You could barely find annual reports. But I find this book, start reading through it, and it makes perfect sense, right? So it's true, right? Once you get inoculated, in investing this way, that's how you kind of continue forward. So let me cover the initial years of what I did, and I saw of quite a few hands go up, so I can pause and I can take some questions. So this is what I did, right? I read, you know, this person, he just fascinated me, right? Warren Buffett, he just fascinated me. This is when, before Warren Buffett, to my surprise, became such a well-known name even in India, right? I'm talking of, this is before 2000, right? So People barely spoke about value investing. Forget about Warren Buffett and all of that, right? Stock markets were, all about, okay, most of the people thought it, it was pure gambling, right? There was no investing per se you could do in the stock market. So at that time, started reading about, all the other books, right? And one thing led to the other. I read, and I forget the count also. These are just some books which I could remember, right? So Making of an American Capitalist, again, a kind of a biography on him, and then Security Analysis, and Intelligent Investor, and Common Stocks, and the some of the well-known books which are there, right? And at that point of time, it's a very interesting time. I can still remember it. Very few annual reports you could get. You have to go to the broker's office, get the report, and some of you would think, right, oh, you know what, this is such a pain. But you have to realize, right, as information has become easier to get, right, and easier to analyze, it's easy for you, it's easy for everybody else, right? And that's a continuous theme. You will see that when something gets easy for you, it gets easy for everyone, and competition increases. And when competition increases, returns go down, right, in that specific area. And then you have to find something new. You have to find some new niche. You have to find some way of doing it different. You can't sit and say, अरे मेरे time में ये होता था, and that mera time could be just 5 years back also, right? Markets move very fast. So anyway, at that time, my investing was completely random. One day on Economic Times, I found a company called IFCI, and this guy had recommended, looks very attractive, has high dividend yield, go ahead and buy. And as it happens to most new investors, right, you go ahead and buy it, and then you promptly lose money. Because if you don't, for those of you who don't know IFCI, this is a development financial institution. I have not even checked whether it's listed now. I think it is, but it's it's like a development financial institution. Pre 2003, I think, IFCI, ICICI, and IDBI were three development financial institutions, kind of promoted by the government of India, and they used to provide long-term project financing. Then ICICI Bank IPO came, got reverse merged into ICICI, and we can, and you guys, if you have any questions around that story, we can talk about that also, because a lot of similar stuff is happening now, right? HDFC Bank is getting reverse merged with HDFC, but not the same set of problems, but again, very similar, right? So anyway, bought IFCI, high dividend yield. And why did I promptly lose money? Because this company had given money to all kind of projects, right? Long-term financial projects, all, let's say infrastructure projects, steel plants, you name it, right? Banks used to not really lend in that space in that era, right? It used to be mostly working capital loans from banks, and IFCI used to give money to to all these projects, right? And they lost money because projects in India, it's nothing new, right? We've all, if anyone, if you have seen, I think it's what IDFC First Bank, right? So IDFC, also lent in the same space, and have had trouble since then. So second bank, this one exists now, obviously it's a healthy and a well-functioning bank. Karur Vaishya, amazingly, was cheap at one time's book. I bought it, but again, sold early, and I missed a 5x. And then Larsen and Toubro, obviously, one of the giants as of now, was a very well-known company then. But this is pre-demat era, so got cheated by the broker. The broker did not deliver the share certificates to me. When he did all kinds of they basically never delivered the certificates to me. And then when finally I got something back, it wasn't the share. So again, I missed a 50x, and why not buy it back again? I just don't remember, right? Maybe I lost interest in the company or whatever it is. So let me stop here. I think a lot of participants, Ishmohit, are raising the hands. They have some questions.
Sir, we can continue. I think raising the hands also happens by mistake, actually. So we'll take the questions, I think, by half an hour mark, or we'll do detailed question answer by the end.
Okay, no problem. Okay, so anyway, that this is how I got started. And again, I think most of us do in the same way, right? We all make mistakes in the beginning, right? And then the mistakes differ, but it's all part of the process. So the first thing I think the first learning is, should not get, disappointed with that, right? Again, use that, as a, as a process to, improve. So anyway, this is 2000, early 2000, I got swept by the, the same thing, right? By the dot-com boom. There was this, again, you have to remember, right? I'm reading Warren Buffett. He talks about, all, being rational, analyzing and all of that, but it's easier said than done, right? When you see everybody around you making money and everybody saying these companies will change the world, right? Sounds familiar, right? What's happened in the last 3 years, right? These companies will change the world. uh, you know they will keep growing because there's a huge TAM, total addressable market, and a bunch of things. You tend to get tempted. So anyway, again, I was thinking at that time, oh, let me diversify, let me not just start invest in the types of pentamedia and I think I even forget other names also, HFCL or something of that sort, right? So I invested in the internet focused mutual funds, right? I still remember the name, will not get into that, right? And I invest in that, and again, if the sector goes down the drain, then what will the mutual fund do? But anyway, I invest in that, promptly lose 70% of my money. Also invested in a company called SSI. This is no longer listed. This company was, in the, I think in the education space for, for software professionals, and they also had, some kind of, offshore delivery and, projects and this and that. And again, I forget some of the details. At that time, they were, what I remember was they were growing at 40% plus, right? They had been growing for the last 2-3 years. So I very naively create a spreadsheet, put all the numbers in the spreadsheet, and then as often we as investors do, start projecting it forward. So it's selling at, interestingly, it was still selling at around 35-40 times earnings. That used to be very expensive then. That's changed in the last few years, but it used to be very expensive then. And if you project at 45% per annum for the next 3 years, stock starts looking cheap. And again, you will see echoes of this happen now, right? Companies which are growing high, selling at a high PE, they look cheap 3 years from now. The key is not that they will become cheap. Of course, if you project the numbers out, they will become cheap. The key is whether they will keep growing or not. So the dot-com boom, it ends, and promptly SSI's business, kind of uh, first of all, it stops growing, and then the stock, and then obviously they start losing business. They start losing some of the contracts, and a lot of students who were learning, let's say, Java and a bunch of other things, they start dropping off because the demand just fell off. And and again, there were certain management issues also in terms of some ethical stuff in terms of what they had done. So once again, time and again, we'll see the same thing, right? Once a wave or a some uh, a boom, or that euphoria ends, the damage is pretty extensive, right? Doesn't matter what that euphoria is, right? It later on it was in the real estate space, in the infrastructure space, and then in the recent past it has been in the and again in the SaaS space and all of that stuff. And when this boom ends, the damage is pretty severe, right? So again, SSI dropped 80% plus. And very naively, I kind of thought, let me just buy and hold, because why? I was reading Warren Buffett, and he says you should be a buy and hold investor. So I just bought, and I held and I held and I held, and I promptly lost most of my money in this stock. So overall, experience of losing 25% of my small capital, it was painful, right? But it wasn't damaging, and so that's the other thing, right? If you have to make mistakes, make them early, right? Because you may lose a large amount of your capital, but when you're just starting off and the amount of capital is very little, at least there's no permanent damage. But then at that time, I promised myself, I'll never follow the fad of the day. If the world is going in direction A, I will go in the opposite direction. And I think there are some of these mental thumb rules which I have come up with. They're very, very useful. Of course, you kind of tend to lose out some of the times. They don't work all the time. If you just make a concrete rule, for example, I have one which says, just a mental rule which I follow. I never try to justify these things. It's like, don't don't buy IPOs, right? And you'll say, this IPO was good and that IPO was good, and that's true, right? It's not that all IPOs are bad, right? But it prevents a lot of pain, right? A lot of, when do IPOs come out, right? IPOs will come out, at the time of, let's say, when the market is really, very, very, very in a bull phase. And I've written about this in the blog, so you can, always search it and find it. And the promoters, promoters would want to sell their stock, when the market is doing well and when they can get a good valuation. So you can't expect the promoter, and it's unfair, right? You can't expect the promoter to undersell his company. Why somebody who spent 20-25 years in building the company would want to sell it to you as an investor on the cheap, right? Will you do that, right? I would never want to sell my whatever I like. If I have something in my house, I don't want to sell it at a discount. I'll at least want to sell it at fair price, or if somebody is ready to give me more, I'll sell it for more. So that is what happens, right? The most ethical guys will at least sell it for fair price or slightly over fair price. The unethical folks will sell it, will just dress it up and sell it for a much higher price, right? So when that happens, the stock is most probably overpriced, right? There's a euphoria around that stock, or there's general euphoria in the market. So you have two strikes against you anyway, right? So the odds are against you, and I think that's the other point, right? So when the odds are against you, the chances are that you're finding something which will not work out well for you in the long run. So that's again just a very simple thumb rule which I have followed. Again, I've changed, I've worked around those thumb rules. I've I don't follow it to the T, but at the same time, uh, I do at least keep that in mind, that I will not follow the fad of the day. So if everybody is talking crypto, I'll dabble around it, I'll read about it, but I'm not going to put a substantial amount of money till that, till there is there is more maturity in that landscape, and I know what I am also doing. Again, you sometimes lose out, because of that, and I'll talk about it at a later point. But broadly, if you manage risk well, this helps you in managing risk much better. So that's what, that was the learning from that point of time, that I'll avoid all kinds of euphoria as much as I can. So let me move on to the next phase. What I've done is I've broken these my experiences into different phases, and when I say different phases, obviously initially was the learning phase. It didn't matter what was happening in the market. When I was clueless, whether the market is in a boom or in a bust, I'm making my own mistakes, right? And then 2000 to 2003 was, a phase when the market boomed in India and then crashed. And at that point of time, obviously I lost money with everybody else, and I was mostly, learning and figuring out stuff. So by that time, I'd become very focused on quality, right? Had taken, the whole, I had the whole Kool-Aid from Buffett, completely focused on quality, buying quality at a price, that kind of stuff. And interestingly, was a perfect time to be doing that, right? So at that point of time, these are some of the companies I bought, right? Blue Star, Concor, ICICI Bank, and you can see, the real good quality stuff, right? All these companies are still around, and actually not around. They've thrived since then, right? I mean, now a lot of these companies, people sing praise about it, and call them compounders, if you may, right? But these were high quality companies. Interestingly, they were available at very, very cheap valuations, right? I mean, these valuations would appear mind boggling to you. And I still remember looking at some companies like an Asian Paints, and that's a very interesting case study, which if required we can go more into it during Q&A. But I still remember, right, looking at Marico, and I had a very good friend who was working with them, and this was selling at maybe 10 or 12 times earnings, and so was Pidilite. And mind you, I was working with Asian Paints, so I'd seen Pidilite, as I was in sales at that time, so I used to, I was a sales manager in the South. So when I would go to hardware stores and companies, I mean, and meet dealers and all that, I could see, on a day-to-day basis, what you mean by competitive advantage for a company like Asian Paints, right? Or even for a Pidilite. And in my mind, competitive advantage was, even if they tried to substitute the product, they could not sell something else. And if I ask for my payment, like if we sold something to a dealer and the dealer said, I'll give you the payment next month, and you cut him off, that's it. His business was dead. So there was no way, obviously your dealers could do anything against you, and the customers asked for it. So I could see all of that. Bought these companies. The market went up 6 times, right? From 2003 to 2006. So again, obviously when there is a wave and you pick reasonably good companies, you benefit from that. So I always feel, right, it's better to be lucky than smart. Why? Because when the market is doing well, all that you have to do is you have to point your sail in the right direction, right? And then when there's a wind in your sail, it just carries it with you, right? So at that point of time, at least what I think is, you shouldn't try to be too clever, right? Just try to find a good company, find good companies, and ride that, right? I mean, you'll do well along with everybody else, as long as you don't try to do crazy stuff, which is what happened at least in the last couple of years in the US. But again, so at that point of time, towards the latter part, real estate and infrastructure started getting a lot of excitement. People thought real estate, the land bank story, which most of you would have heard. Infrastructure, again, I use my simple thumb rule. If everybody is going into that, I won't touch it, right? And very naively, I did not even bother to look at it. So you had the and I forget the names also. There were all these companies which went, DLF obviously was there, but there were all these small companies which went up 200 times and 300 times. They just completely avoided them. What also helped, interestingly, is that there was no social media then, right? There was no social media. There wasn't YouTube. And I anyway, I've never watched financial channels on TV. So there was very little peer pressure, right? I mean, there was nobody talking about investing in general. So nobody saying, I made 300% CAGR in the last 2 years, right? So when nobody says that and you're on your own little world, you don't know what you're missing, right? So that plays a very important role. I think investing is much tougher, not because it's gotten any more complicated, but there's a lot of FOMO outside, right? When people are saying how well they are doing, it to the best of us, it can get to you, right? And it's not easy to escape that. So that's that's where it's getting tougher and tougher, because it's all in your face. Again, I've always felt this is almost 10 years since I started investing, and I was always concerned how much of my returns were due to skill versus luck. And I think that's a very important question all of us should ask ourselves, right? We can always think after investing for a year or two, what, I'm the next Warren Buffett, right? People go on social media and talk about it, right? Or they claim themselves. We may all think we are all we are very humble, we're not thinking that sense. But when you do well, right, it can easily get to you, right? You can always start thinking, last 3-4 years, my CAGR is 40%. I'm the smartest guy around, right? I really know what I'm doing. And when you start thinking that, they, this phrase you would have heard, right? Don't confuse brains with bull market. That does happen to the best of us, right? No matter how much you try to avoid it. So I was still quite wary. I was not sure whether this is all skill or luck. And the reason why I shared my beginnings is that my own experiences, I've always been very risk averse, right? Like I don't want to go bust. There's no reason for that. So even at this time, although I'm investing in all these good companies, I still had some of my money in mutual funds, right? So there was always this thing, right, just in case, right? I mean, there was no safety net per se for me. So it's not like I can afford to lose all the money in the market, and there is somebody who can backstop me, right? So when you're thinking in that sense, and capital is precious, so always thinking about skill versus luck. I even think about it now also. But I did not allocate enough, so there is a 6x increase in the market. I obviously benefited from that. But it also comes down to, that's another very important piece, and we can talk about it later. That stock picking is great, but I think it's overrated. How much you allocate to equities, how well you diversify, how you manage risk. Those are the less sexy parts of investing, but sometimes over a very long period of time, they're equally or even more important. So anyway, good times. Some learnings from that era, right? So again, I sold a lot of these compounders, and they were not called compounders then, right? Nobody, the market or investors, first of all, nobody was writing about it anyway, but separately, a few articles here and there, a few, a handful, maybe one or two bloggers here and there, but so nobody used to call them compounders, right? They were just good high quality companies. But I sold them, quite early. So I bought Blue Star, bought it, sold it mid 2006, 6x, feeling very proud, very smart about it. And then it goes up 7x after that. Marico sold 2006, 20x up after that. Asian Paints is always, something which is like, always, stares me in the face. This is one company which I used to work, knew it in and out. I've never found any company which has been run as well. I mean, personally, obviously there would be other companies which are run equally well, but at least I have not found any. And up 50x, right, since then, 2007. So what did I miss, right? And again, I always thought about quality as high ROCE growth, and those are definitely very important components. But it's also about durability and predictability of this growth, right? When we look at ROC growth, it's there in the form of numbers, right? It's staring at you, right? So you can easily run a filter or run a screen and say high quality, because it has X ROE, it has X growth. But what often gets gets ignored, and the market is very good at discounting, is the durability and predictability of this growth, right? And again, this is not something which can very easily be inferred, right? A company could be growing for 10 years and then that's it, it starts saturating its market and then it stagnates, right? And that has happened to a lot of these compounders, right? They grow for a very extended period of time. And an example which I've not taken in the slide, uh, maybe there are two examples. One is, for example, Manappuram Finance, and the other one is Shriram Transport Finance. And I'm sure all of you have gone through that excellent presentation by Digant, right? Now, Shriram Transport is one of those companies which I bought in early 2011 or 12, and they'd been doing very well for 10 or 12 years, right? They continue to do well, right? But the stock didn't go anywhere. Why? Because that space kind of started getting saturated, right? And then the world moved beyond them. Same thing happened, for, let's say, the gold loan companies also, right? Manappuram has stagnated because the world has changed around them. So it's not about just high ROC and high growth in the past. It's also about durability and predictability of that growth, and that requires a lot of time and effort. Now, some of these companies like Asian Paints, right? They've kept their competitive edge in the market. Their markets are stable, right? It doesn't yo-yo up and down, right? Like crazy, right? There's a lot of entry barriers. The same 101 which you read about competitive advantage. Right? So there's a case studies for that. But again, as I've written in the last bullet, right? It's not everything is buy and hold, right? It's only reserved for the select few, and often it is only known in hindsight. So you can't just make it a religion, right? Okay, I'll buy this company and I'll just hold it to the thick and thin, right? It's not like you have to do it, right? It's I think of it more as buy, analyze and then hold, right? Unless I mean, you'll not change it for every small little wiggle it happens in the stock, but then there should be a strong reason to continue holding, right? So anyway, that's what I that was my experience during this particular era from 2003 2008. Good times, bull market, everybody making money, a lot of people making a lot of money. And then as Ishmoit was sharing, right, I started a blog in 2005. So why did I start that, right? This is a time where if you did a Google search, you could not find anything, right? And one thing which I've done all these years is I've always kept, extensive notes. It's all over the place, but I've always kept notes on my investments. If I'm reading something, if I have an annual report, I will download it. Uh, you know, have a big folder now of all the files and all the annual reports and conference call. Nothing very structured, not like some major formula, but I always download and I keep it. And I was writing anyway, right? Just making notes. I started creating a spreadsheet where I would analyze the financials, financials, have a checklist, bunch of things. And the checklist just kept growing and growing and growing. And we can talk about it also. I've not covered it in the presentation, but so I was writing anyway, right? So I just started a blog, and blogging was not really a thing then, but I just started writing anyway. And then nobody read for the next 2 years, right? So anyway, this was 2004. This is the first post which I had put up, right? Interesting post, right? Still talking about market size, market timing and all that. But anyway, that is what it was. And I just kept doing it, right? If you ask me any value out of it, absolutely nothing. Any plans around it? No, nothing. It was just on a whim, right? So that's how I've followed investing per se. If you look at it, just on a whim, based on what sounds interesting to me then, right? So that's how I started. And often, when you come across something, I think that's how we should do it, right? Not everything is about money. Not everything is about a particular CAGR. Sometimes if something really interests you and it's a hobby, just go ahead, right? I mean, who knows where it will lead to, right? So I would highly encourage, picking up something which you think is interesting to you. Anyway, this brings us to the great financial crisis, right? By 2008, I had I didn't have a very high allocation, as I was telling you, right? A lot of it is accidental, a lot of it is just luck, pure dumb luck, right? And that's another common theme, right? We are all lucky folks, right? You guys, are interested in this topic of investing, are there on this call on a Sunday evening. I can assure you, majority of you will do well, or almost everybody will do well, right? The only thing which will get in your way is yourself, right? If you want to get there very quickly. But just that, because you are with Ishmohit, you're learning all of this stuff, you're interested on a Sunday evening, right? When a lot of your friends are out there, having a nice time, that puts you ahead. Believe me, that puts you ahead of 99% of the people. Over time I've realized, majority of the people are not interested in this topic and are not really, very savvy about finance, about investing. Forget about, really getting into it. So that just puts you ahead of 99% of the people. So you will do well, right? It's just that, you should not be in too much of a hurry. So by this point of time, I'd spent almost 13 14 years in learning about investing. Had low allocation, right? I always, very cautious, very chicken, right, about investing. So I had enough cash during the downturn, so I didn't get again, believe me, it was far more scary than even the COVID. COVID was a very interesting time. The market went down vertically and kind of just went up again vertically. And I'll talk about it a little bit, how this experience kind of shaped my experience in 2020. I didn't expect it to suddenly turn around, which is another thing which, everybody has to keep in mind, that not the same pattern will happen in the future, right? So for a lot of investors in this area, 2020 seems to be the basic template, right? Market drops and then suddenly just bounces back, right? So what should we do? When the market drops, we just start averaging down, right? But anyway, that was not the case in 2008. Started dropping in early, mid 2008, and then it just kept dropping and dropping. And by the end of the year, things got crazy cheap, right? And so at that point of time, there are times in life where, you don't have to really scratch your head and, do some. All that you need is, courage, and just throw money, right? Like that's what I did. If you look at some of these companies here, right? I have these names listed out, and some of them are, I analyzed it and I put it on the blog also. At that point of time, it was allowed, right? There were no SEBI regulations at that point of time. So bought a company called Lakshmi Machine Works. I'll talk about it a little bit. So I bought Hinduja Global. This is HTMT now. These companies were selling close to cash, less than cash. Ashok Leyland selling for a few bucks, right? And then I sold them when they reached fair value. That's been a very regular theme. Let me talk about one of these companies, right? Let me talk about Lakshmi Machine Works, and then maybe we'll take up a little bit of a pause. We can have questions. We're talking for some time now. So this company, it's still around, right? This company makes textile machinery, right? That point of time, it was close to a monopoly. It used to have like 60-70% market share. They had a collaboration, and I'm going by memory here, I think with Writer. There's another company, global company. So they used to, kind of get machinery from them, and they would supply this textile machinery to, to all the, all the looms, and they had these loom machines and weaving machines and carding machines and all of that, right? So obviously, 2008, the market collapses. Uh, the textile sector also gets impacted, and anytime when you have these capital goods, kind of capital goods suppliers, right, when the market drops, their orders just completely dry up, right? Like if there's a textile manufacturer, textile is anyway not a very high ROE business, right? So when they get into stress, what is the first thing they would do? They would start putting new orders in. So all that, the order book for Lakshmi Machine Works, that dried up. It's also called LMW. All they had were a few pending orders, and then they obviously get these maintenance orders and some parts and replacement. So more or less, most of their orders dry up, and the stock just crashed. I haven't put the, okay, my apologies, I haven't put the timeline over here. So this is roughly around 2008 and to 2009, this time period, right? And the company is selling for less than cash. And I still remember I put this in the blog, right? This is selling in cash, and I made a few jokes also that the only reason this company will go out of business is if we all stop buying and wearing clothes, right? Like, what scenario can you think that this is almost a monopoly in this sector, supplying to all the textile companies in India, and this company goes out of business? Now, one scenario you can think of, it goes out of business, it had debt, right? And if the whole, and by the way, it all looks good in hindsight, but at that point of time, you're talking of this, one of this big financial crisis, right? The markets are down 50%, companies are really struggling. So you would think, if textile companies don't do well for the next maybe 3 years, this company is toast, right? But to keep in mind, this is a very old 20-25 plus year company, even at that point of time. And they were, they had quite a lot of cash on their books, right? Like sufficient amount of cash on their books. And then I did some calculations, right? If they did absolutely no business, and this was very useful, by the way, to do in 2020 also. And if you folks have some questions, I can share some examples, right? Whenever such extreme scenarios happen, right, one of the things which you can do, which I did for 2020, was pick up your company, right, and say, revenue goes to zero, how long can they survive? Because at such points of time, all that you're trying to look for is, there's no, you don't have to sit and do some DCF and this analysis and that analysis, right? I'm talking of some real severe scenarios, right? The world is literally feels like it is going to stop. All that you need to do is, will my company survive for the next 2 to 3 years? If you can answer that yes, you just go ahead and buy it, right? Because all that, as I was saying, right, all that you need is courage, and your company has to survive. It should not go to zero, but you're not going to put all your money in some two companies. You'll do a basket, right? So just run through that company, go through all the financials, and if I can find, I can share those notes also with you guys. Maybe I'll pick up one of those from 2020, which I did. Uh, and just run through that, right? Do an analysis, look at, how much cash do they have, what kind of credit rating do they have, where can they cut costs, if they cut their costs, how long can they survive? So I did that for this company here, very very quick analysis, and said, realized worst case scenario, at least they can survive 2 to 3 years, right? And then they can take some money from the bank also, right? So let's say they cut costs, their cash can run for 2.5 years, a little bit of revenue keeps coming in, then after that maybe they can go to the bank and get some money also. So theek hai, mota moti they can survive for at least 3 years. So with that logic, I said, okay, chalo yaar, you know what, uh, we will all keep buying clothes. Obviously, in the worst of the scenarios, right, food, shelter, and clothes are the basic need. So all these textile companies will keep running. 2 to 3 years later, at least some of them will have to put some replacement orders for sure. These machineries are what, 8, 10, 12, 15 years, right? So some revenue will come in and this company will survive. So again, go ahead and just bought this company. And then, the markets obviously slowly started recovering, and so did this particular company also. So, very different scenario then, right? You can see, right? 2003 to 2008, you know, world is doing well, everything is going up. That point of time, made sense. Again, all of this, by the way, is all in hindsight, right? I'm kind of putting all this story together. It doesn't feel like that, right? It's not like one day sitting in 2005, I was thinking, chalo, let's do all quality. Then 2008 comes and I say, now, chalo, let's become a Graham investor. Nothing like that, right? It's all based on what opportunity comes in front of you, right? So just go ahead, buy these companies. And I did that for quite a few, right? Bought Ashok Leyland at a bottom. Merck was selling at a very rock bottom price. NIT Tech, why not buy some of the other technology companies? I mean, I don't know. This just appeared very cheap, right? So just bought NIT Tech. By the way, I also bought Maruti at that point of time. Again, selling very cheap, all cyclicals. I didn't realize that is what, I just found it cheap, so I bought it. So it was a good time to buy all cheap stuff, and then, kept selling those things, right, as they approached fair value towards the mid to the later part of 2010. So, it was a good phase to, get into that kind of stuff and, do well. So I'll just take a pause here, Ishmohit. Been talking, it's been a one-way monologue. So, just take a pause. Let's see if there are some questions.
Right. So I'll just first lower all the hands. Then if there are any questions, so I'll request everyone to raise their hands, and then I'll just unmute the speaker, like the audience, if they want to ask the question. So will that work, Rohit sir?
Yeah. Go ahead. Any format is fine.
Right. So I'll just mute Mayank. Mayank, you can ask a question first. Mayank, you can talk. You can unmute your line. I think he's
am I audible?
Yeah, you're audible, Mayank.
Good evening, Mr. Rohit. I just wanted to know, you just mentioned that they were selling for less than cash.
Right.
I mean, how do you check out this parameter?
It's very simple. When I'm saying selling for cash, I looked at the market cap. So I'm just going very roughly, right? I don't remember the exact number. The company was selling for a market cap of 700 crores, something like that. And they had cash on the books of around 900 crores. So like selling as in, like, if you took the full company, and and I don't know if if you look at what Graham, who was Warren Buffett's teacher, he invested during the the depression era in the US, right, from 1920 I think 8 or something, 35 or 36, right? And at that time, similar severe crisis in the US, right? The stock market actually went down by 90%, and the investors were so shocked and were under so much stress that and it does happen, by the way, right? And it happens not often, but it happens once in a while, that when there is so much of a stress in the market, some companies unbelievably will sell for even less than their cash. I mean, hypothetically, if you took the company, sold it off 100%, and so let's say you bought a Lakshmi Machine Works from the promoter. I'm just saying, this is like just a thought experiment, right? You went to a bank, you borrowed 1,000 crores. You went to Lakshmi Machine Works and you said, I'll buy your company. He'll say, "Theek hai, ye lo, buy it for 700 crores because that's the market cap." You bought it. The company has 700 crores of cash on their books. You can, 1,000 crores, right? So let's say the company has 1,200 crores of cash on their book. You could actually liquidate the full company and you will be left with 200 crores after that. So that is what it means, right? That the company itself, the market cap is less than the cash it is carrying on the books. So the market is giving zero valuation to all its, hard, like working capital, to its inventory, to its receivables, to its fixed assets. Forget about the intangibles, about brand and relationship with the customer and everything. The business is being valued at zero, or it's being valued at actually a negative EV, right? Negative enterprise value. Happens very infrequently, but it does happen during extreme stress. So that's what I mean by selling for less than cash. Market cap less than cash on books. Simple formula.
So
Answer your question? Yeah.
Everything is
Go ahead, Ishmael.
answered. So I'll just ask Sunny. I've just unmuted a line. Sunny Kumar, you can ask a question. I think, yeah.
Hello, am I audible, sir?
Right.
Yeah.
Sir, I have just one question. You are saying that you have bought when the market crashed. So actually, you were following the idea of buying the pessimism.
Right.
And And how do you keep away from those person who are making the money in that time, and you keep away from yourself from FOMO?
So that time it was much easy. There, as I was telling you, right? Not there was no Twitter, no social media. So it was like, you are kind of shielded from that. Become very difficult now. Okay. It's uh, now it's all hitting you in the face. So one of the ways I usually what I do is, if you really are itching to do something, you set aside a small amount of money on the side, right? You'll say, let me keep 5% of my funds. These are all just mental tricks you have to do to kind of keep yourself from sabotaging your own portfolio, right? So each one of us will have to figure out our own ways. One way which I do is, let me just keep a small amount of capital on the side and just keep that as my FOMO bucket, right? Do whatever you want in that bucket, right? You trade in that, you buy some of these FOMO stocks, you kind of just create a small allocation and study and understand. But you have to always and I think think of it this way, right? I sold my Asian Paints early, right? Because I thought the valuations was high. So nothing is free, right? In the markets, as they say, if you are away from these stocks, you're obviously not going to make money. Or if you set these rules that I will not go to these hot sectors, you will somehow sometimes miss out on the sectors which deserve to keep growing. So again, there is always a downside to it. But it's saying that I will stay away from social media, or I will not read it, that's not really practical. You can't avoid that. I think what has worked much better for me is create a small little uh, side pocket, or small fund on the side, and invest in that. And then one or two of these positions will turn out to be good gems. You can buy in that. And the rest, if you get caught at the wrong time and the whole market goes down, you're the damage. Again, it's all about the portfolio, right? It's not about individual stock. That the portfolio will not get damaged, right? And you'll survive to live another day. So that's what you have to do. But yeah, it's one of the toughest things, right? It doesn't go away, right? No matter how long you invest, envy, when you see others doubling their money every year, it is going to tempt you. Believe me, no matter how many years you do this, it's a tough one.
Right, right. So I think next question I'll just take from Akshay's line. So Akshay, I've unmuted you, Akshay Kothari.
Yeah, thanks for the opportunity. I just had one question. In the current scenario, there are various EPC companies, be it to just name few, Power, Mech, KEC, Titagar Wagons, they are having a robust order book. So, uh, considering that by this logic, no, though it is not the same logic as what you had said, and commodity cycle reversing, so these companies would actually gain. So, what are your views regarding it?
See, again, these are I mean, I've not looked at the specific companies broadly at a sector level, right? It's all your EPC companies, these kind of companies, they are in the capital goods space, right? And the one thing which you have to do is you have to look at a much broader long-term history of this particular sector, and you will see that all of these companies, and the sector goes through these cycles or these waves, right? So that's what happened if you really look at. And I think when we get into the next part of the presentation, we'll talk a little bit more. And I've not put some examples, but there was this whole capex cycle from 2003 almost till 2008 or 9, right? Because that's what happened, right? That time the economy boomed, so all your capital good companies did well, like like the BHEL. And I've not taken again BHEL as an example, but that was one. And so for example, I'll give you a very quick rundown on BHEL, right? So BHEL, in the power sector, right, used to have all kinds of power sector products, right? Transformers, alternators, this, that, everything. And the power sector boomed in that 2003 to 2008 because the industry was doing well. And all the EPC contractors, the equipment suppliers, everybody was doing well, right? And as it happens in this sector, that you will have, when you have a boom year, the profits are mind-boggling. And when you have bad years, a lot of companies go bust, right? Only the best are able to survive. What usually happens is, a lot of this is known only in hindsight. You have to be careful when the boom has been going on for some time. Now, for now, it doesn't appear to it. It's been like almost more than a decade. since the last boom ended. So how long it will go, that's a crystal ball, at least, very tough for anybody to say. But appears to be, the initial years of a capex cycle. So when that happens, right, there will be a lot of skepticism. It's only when the companies start appearing to be very cheap and everybody is talking about, that, the next 10 years will be great and EPC companies will do well and power sector companies will do well, etc., etc. That's when you get, you have to get cautious. But keep in mind, this is a cyclical sector. This is not something which you would hold for a very long time. So you have to be careful, right? The timing element is definitely there in this sector. So I don't know if that answers your question. I mean, it's tough to get into more details other than looking at the company itself.
Yeah, thanks a lot.
So I think, sir, we'll just take one last question, then we'll proceed.
Sure.
I think
Sure.
From Ayush Agarwal's line. Ayush, have unmuted your line. You can ask.
No, thank you, Ishmit, and thank you, Rohit sir, for giving so much wisdom here. My question is actually two questions, but very related to each other. One is, do you maintain some sort of a watch list when these crashes happen, that that these are set of companies I have to look at? That's one. The second one is, even not in a crash situation, a promoter should be knowing that what its company worth it, like from a long-term perspective, what they're doing, what they're planning, their vision and everything. So should we take any other triggers which is as good as looking at a below cash kind of evaluation, which can lead to pick up stocks? Such stocks may not be as cheap, but at least we know that we are getting it at a very, very good rate.
Right. Okay. No, really good questions. So first one, right? Watch list, yes, absolutely. I've always had watch lists in the past, and I do it. Right? There are two. Actually, this is how I keep my watch list, right? There is obviously a current watch list, where I'm looking at companies at different stages, right? So, for example, right, and I'll talk about this a little more in detail about how I find ideas, right? No standard formula now, right? Ishmoit puts a video, I'll watch it. Somebody says something about it on Twitter, I'll look at it. People who I like, who I know are doing in-depth analysis, I'll look at it. So anytime anybody recommends or even emails me about a company, I'll look at it. It has to obviously, it has to make sense to me. If it does, I'll put it on my watch list. I'll keep tracking it, right? So that's part one. But then more importantly, I have not a watch list, I have a wish list. And I've, over time, I've kind of developed that. And what is my wish list? It is the bluest of the blue chips, right? So I'll have a Titan. I'll have a HDFC Bank. I'm just making this up, right? It may or may not be on my watch list, right? I'll have an Asian Paints. I'll have this company where I know these are really good companies, have held for a very, have done very well for a long time, and they are not yet saturated their market. And what is this wish list? Let's say tomorrow, if the world goes completely haywire, right? Like, the worst of the worst thing happens, right? At that point of time, what everybody is thinking is, the world is going to end. Think of it, what happened during 2020, depth of the market happens very, very rarely, right? I mean, fingers crossed. I hope it doesn't, stock investing is not the end of the world, right? You don't want the world to end just because you can pick bargains, right? But it happens, right? It happens. It seems to be happening every 10 or 12 years. So when that happens, you have to think about it in this way. If the world truly ends, right? Like something very dramatic happens, then what company you put in and what you invest is hardly going to matter, right? If everything really, the worst possible situation happens to humanity, then this will anyway not matter. But people figure out ways, solutions, humanity does recover, right? Then these companies which you are holding will do well, right? So at that point of time, money investing is the last thing you want to think of, right? Like in the depth of 2020, all of us were thinking about how to be safe, how to take care of our families, how to take care of our health, right? Who was sitting around and looking for cash bargains. This 2008 was a financial crisis. So anyway, at least you could think about it. So I have this wish list, which I will keep, which at times of extreme stress, I will pick that up. But beyond that, the run of the mill recessions and the run of the mill drops in the market, 20-30% are really run of the mill drops in the market. There is a wish list which I'm tracking. And then obviously it's in the context of the how the various sectors are doing, and I'll keep it at the sector level and I'll keep it at the company level. So yes, that's maybe the answer to your first question. and then it'll be there'll be a few points on it, right? And the other thing which I also do is that after I've looked at a company, I'll keep some notes also. I'm not very good at that, but if I look at a company, I'll just write a few words around it, so that when you go back, you tend to forget, right? And another area which you can actually do is companies which you have bought in the past and you have sold, right? When they become interesting again, it's not like you have divorced the company and you cannot go back to it again, right? You can always pick that company. So a good enough list which you can pick from. And then second, I know this is a unique situation where you can build, pick below cash. There isn't a very standard formula, right? If I understand your question right, promoters often they know the value of their company, but they get it equally wrong. You'll be surprised how often promoters are far more optimistic. I mean, entrepreneurship itself is an act of being optimistic about your business, right? I mean, it is so tough, right, to run a business in India or anywhere else, right? So obviously they will be optimistic, but yeah, insider buying is a good indicator often, right? If promoter is doing it, but beyond that, Ayush, there's no strict formula, right? And anytime you think you have a formula, somebody has a formula to buy individual companies, we'll keep quantitative analysis and quantitative investing aside. But if anybody brings up a specific formula, then you should be very cautious about it. There's no formula by which you can buy. Only a few times you will think that, oh, this company is like crazy cheap, like doesn't make any sense. Maybe you can start looking at it again. Often it is crazy cheap for a reason, but crazy cheap in which context you have to see. If the market has collapsed, not crazy cheap selling below cash when the market is booming. Never do that when the market is doing well. Then it is below cash because something is gone very wrong with the business itself. So I don't know. Hopefully this answers your question.
Thank you. This is very good. I think very helpful. Thank you.
Yeah. So we'll move ahead, Ishmael.
Right, sir. I'll just turn my camera off. Sure.
Yeah. So anyway, I think 2008 to 2010, right? Again, in hindsight, was a window of time when we opportunity opened up, right? And that's what it is, right? Often you will see that what you end up doing in a certain phase is because I think there was a question, right? I saw it on the chat at the start of the session, right? Have you changed anything in the last 5 years? And you have to, right? When the market keeps changing, you keep changing your approach, right? So there are as many different and I'll talk about a few of these things later. As you see new approaches develop, quantitative investing, momentum, look at it, right? I mean, no need to be religious about something, right? Like I'm a value investor and stick a label on your head and say, I will not even look at something. Whether it makes sense to you or not is a different point, right? So anyway, by the time 2010, quality had started becoming a mantra among a lot of people, right? A lot of new investors who came in the 2008, 9, 2011 and 12 phase. So this was a time a lot of people got introduced to the markets. I could see, blogs had started expanding. There were these, different, investment forums. People set up different chat forums. Twitter was slowly starting to pick up, right? So people started discovering this whole quality thing, right? The whole, focus on quality. Warren Buffett started becoming a very well-known name. So people started reading that. There's nothing secret about it, right? Anybody can read it and understand it. So you could see, right? Quality picking up, a lot of people picking up good quality stocks. And I also I continued with the same thing, mostly growth at a reasonable price, that is GARP, right? And then obviously quality. So some of the picks at that point of time, I've given a very brief reasoning behind it. Saw a company called Amaraja Batteries. It's still around. It was one of those challenger companies which was more aggressive, doing a much better work around branding their product. They were gaining market share from Exide. So it was a good mental model that when a challenger kind of comes around and it is challenging the market leader and gaining market share, usually these such companies are a good purchase. So did some detailed analysis around that and then found that This was a good position. Atul Auto, same thing, it was expanding in the commercial auto space. At that point of time, they were growing very well. Unfortunately, it turned out that they were not really able to make much headway beyond that, right? I mean, Bajaj Auto continues to be a very formidable competitor. Amar Raja was able to grow for a fairly long time. Exide did not really get their act together for some time. Act together in the sense they being able to, they kept doing their thing pretty well, but they were not able to really, meet the challenge from Amar Raja for some time. But then obviously since then, they've kind of they've also started becoming more active. Ashiana Housing was doing well in the housing space, so pick that up. Again, if you all think, all that I've been doing in the last 25 years is of picking all the winners left, right, and center. That's by any remote. This thing is not the case, right? Anybody who says picks is only picking, winners and not picking any losers, is not being, is not being honest and truthful, right? Everybody makes mistakes, right? And I always like to talk and discuss and share my mistakes. I feel no shame in it, right? I mean, that is how investing is. And anyway, I'm not trying to sell anything to anyone. So I first step is to be honest with yourself, and then be transparent with others. So again, I bought a company called Crompton Greaves. We all know that it split later on into two different companies. This was a leader in power equipment. One of you guys brought up this question around EPC and power, um, the infrastructure space, right? And that's the thing, right? If you, one thing which you have to be very wary about is that a sector will keep growing, and then the tide turns, right? It's no longer, the tailwinds die down, right? But it's, some of you would have seen that picture or animation or photo, right? There's this coyote which is running, and then it runs off the cliff, right? And it is still running, right? Although there is no ground below it, right? So that is what unfortunately happens in these kind of cyclical sectors, right? Companies, the boom would have ended, but they're still trying to, they're still, they have some residual orders left. And what typically would happen is that the market, being a discounting machine and does a very good job of discounting, it starts marking the stocks down, right? So these stocks start appearing fairly cheap from a, from a standard valuation metric. So again, Crompton Greaves seemed to be something like that, right? They were a leader in the power equipment, motors, and all that stuff. So it appeared to be good, a good management. They had done global acquisitions. You remember the 2006 or 2000, not 6, sorry, 2008 or 7 or 8 era was also the time where there was a lot of confidence in India and a lot of big global acquisitions happened. Tata Steel went and acquired, companies, in the UK. I think, Hindalco, not Hindalco, one of the, I think the Kumar Mangalam Birla companies went and acquired a company called Novelis and all of that. So pretty big acquisitions, and even Crompton Greaves had done a bunch of global acquisitions. And what happened was, the capex in the power sector capex in these foreign markets collapsed. It collapsed in India also. So all these companies started making losses, and then promptly, this was roughly, and do I have a, no, I don't have a chart, but Crompton Greaves, this is roughly around 2013, I think 13 time frame, if I remember correctly, 13 or 14 time frame, where Crompton Greaves, the CEO, there is a CEO change, and a new CEO comes in, and the existing CEO becomes, I think, the chairman or something, but he sold, most of his stock before he moved out, right? So when that happened, the market really got upset, and because it got blindsided and the stock dropped. And then after that, the numbers started going south, right? So, it left a bad taste for the market. The stock started going down, right? And again, I was holding it, but then, one thing piled over the other in terms of management actions and everything. So again, took a loss on this one, and there is a long list of losses. We don't have enough time to talk through it. There is another niche company, a good company in a niche space for rubber recycling called GRP. Again, it was doing okay, but was not able to scale. So another learning is that if you buy a good company in a very small space, where the addressable market is very small, then it is 101 of of investing. But I didn't look at it closely enough, so didn't do well. Maybe lost a little bit of money in GRP also. So, but more or less overall, this was the time for, growth at a reasonable price plus quality. That is what, again, same thing, right? No specific theme, right? It's always been, where are the opportunities, you go towards the opportunity. And then looking back, you realize, oh, this was the theme around it, right? Instead, you say, I will follow this theme, and then you go looking around, right? Usually that doesn't work, right? So by this time, you saw, right? I'm not talking much about the cheap stocks. And the reason was I still bought a few, but then I realized they were not working, because by that time that, that extreme period had gone away, right? So what was cheap was really value traps, right? These were companies which were not doing well, and they were not going to do well anyway in the future. And the overall stock market had started moving towards growth kind of investing, right? Companies which are growing, market started, rewarding them. And then by that time, I also realized, it's not an efficient use of the time, time invested, because the problem is you buy one stock and it goes to its fair value, and then you have to buy another. And I think I'll come back to this point again, return on time invested. We all talk of return on capital, right? But what is the most scarce time for all, a scarce resource for all of us? It's our time, right? Capital is obviously scarce, but time is even more, right? So I think when all of you invest, you should think about it also from your side, right? Like, how much time and brain damage will I get with this position, right? If I buy this company which is not doing well, every quarter when you look at the numbers, it will make your stomach churn. And then, you know what, you'll make a certain CAGR, right? So, time and effort, and can you really make a big allocation to it? So, Graham style investing, these cheap stocks, good only for a certain period of time, but beyond that, you can't really scale it up. But I know even at this point of time was very focused on valuations and PE of the stock, because it had done quite well. So remember, I was talking about the blog and everything. I at the beginning of the session, I brought this up, right? So that is what happened, right? I started this blog on a whim, right? 2005. There wasn't any grand plan that, this blog will become some advisory or something. It was just done. There was a small following which developed for the next 5 years. And I said, right, that, I just, some readers said, why don't you start a paid service? And I did that. And there was a lot of, huge response. And then my friend and partner, who I've known him for, 25 plus years, we had been talking, but he really discovered me as an investor through the blog. And there's a very, a good learning for me through my blog, and, through my own personal experiences, which I'm sure all of you would also see, is that, you can't, you can't teach investing per se to anybody, right? The person has to have that interest, right? So what I've seen is, I've shared my blog with my close friends, with my relatives, with everyone, right? And they know I run an advisory, but most of them are not my customers, even after seeing the returns, because, their mindset or their temperament is not there. So they just don't want to do it. Every time when they ask me something, and instead of saying, go and buy this stock or go and buy, I'll tell them, why don't you index? Because maybe that's where you are. And the person will look at me and then will not, and then the conversation will change, because what that person is looking is, can you tell me something which will go up 10 times in the next 2 months, right? So when the temperament is not there, you can't, the saying, right? You can't, you can take the horse to the water, but you can't make it, you can't, make them drink, right? So, that's what I've seen, right? That no matter how much you talk about it, the other person has to have that interest. So, my friend and my partner now with my advisory, he had that interest. He started reading through the blog. So, the whatever, I've done in terms of writing, in terms of, my social media, it has led to all these good things, which I can't put a monetary number around it, right? I mean, I'm talking to all of you. I constantly, I'm in touch with Ishmo. That's also due to this thing, right? So it's a lot of lifelong friends I've found, a lot of people I've found, so my suggestion, what, if something interests you, whether it's writing, doing something, just go ahead and do it, right? You never know, right? A lot of things, good things will come out of it. So anyway, let this to RC Capital Management, which is our current advisory, right? And how do we operate our advisory, right? And I'm not bringing this up to talk about my advisory, but just to share my thought process. When we set up this advisory with my partner, we were not doing it for the money, right? Because by that point of time I had been working for a long time, and I had no investing was an interest and a passion for me. I mean, if I just did it for the money, then it would become work, and I didn't want to do it that way, right? So both me, at that point I just started on my own, and I actually worked backwards. I said, okay, what do I don't want to do, right? I don't want to go around selling it, right? And I didn't want to do that, because when you have to sell it, you have to make quite a few bold claims which can come and hit you back. So I didn't want to do that. So I will only sell what I would buy from somebody else, right? Like if I was the customer and you were the seller, I would do that. Then what I said was, I'll have skin in the game. I'll always invest the same as what I recommend. So if I go down the drain, at least, if I do something stupid, which I've done enough number of times, I'm equally hurt than others. Third was, I said I'll be transparent about my mistakes. How can I do that? The food on my table does not come through this advisory. So, if I make a mistake, I'll own up to it. And if people leave, they leave, right? And what I found over time is that, people do appreciate that. If you make a mistake and you accept, people understand, right? I mean, most of them do, some don't, and then they leave, right? Which is fine. And another experience also when you're a public investor is that you're far more cautious when you're investing, for others, right? I know some of you, like Ishmohit, does it for all of you guys, and he shares a lot of these analysis. But you have to be very cautious, because you never know how the other person is evaluating and taking that, and they're putting trust and faith on you, right? So when I invest for my own account, I can do whatever I want, right? A little bit money goes down, big deal, right? But that's not true for others. So again, I set up some of these principles by working backwards, and they helped, right? I mean, it's kept me sane, my partner sane, allows us to to operate this without stress, because there's a lot of stress, enough stress in investing. And if you're doing this for others, if you don't keep it low stress, then you cannot survive. So anyway, again, if any one of you ever thinks of going down this direction, keep this in mind. Think about where you want to reach, right? You may get tempted to grow quickly and all of that stuff, but and nothing is free, right? So anyway, so let me move beyond 2016, right? And this is a time when quality had become like a like a religion, right? Everybody is talking about quality, this Buffett, that Buffett. It's like there was such an overdose of Buffett that I stopped writing about it on my blog, because it became a bit too much, right? It almost became like a religion, right? You can talk and sell anything or talk about anything, just stick a Buffett name to it, right? And that's it, right? There are companies, like I used to see these discussions around Asian Paints, 10% grower selling at 80% or 80 time earnings. Maybe they will, but I mean, I could not digest it. I could not figure it out when a equally good company in the US or global markets, half the size, or sorry, half the valuations, and equally good franchise was selling at half the valuations, right? So anyway, I could not get around to it, so I just moved on, right? Same thing, quality was a fad at that time. I said, what, I'm not going to get into that fad. If others make money, more power to you. I won't do something which does not make sense. I make enough mistakes. I do enough stupid stuff on my own. I don't want to add one more to it, right? Again, another learning, right? I started avoiding labels, right? Call this quality, call value. What happens with labels is that it closes your mind, right? The moment you say I'm a quality investor, you will look only for a certain set of factors, right? And all these labels are are our own constructs, right? When you look at a company and you call it quality, you're not looking at other aspects of it. So avoiding labels, right? Stopped avoiding labels, right? Again, I kept looking at companies where I understand the theme, started looking at a range of earnings and a value. So prior to that, when I started my whole career, I was like a major DCF bhakt, right? Discounted cash flow, right? I would pull a spreadsheet, put all the numbers, I still have those spreadsheets, put numbers, put a terminal value, sit and do this whole mathematical exercise and do a bunch of things. And then I realized, it's an overkill. Because anyway you're doing estimates, all this formula, it really doesn't get you any closer. It just gives you a false sense of precision. So instead of doing that, I slowly moved towards a scenario where I would take a range of earnings, put some kind of an estimate of a multiple and look at a range, right? Look at it like a distribution, right? This company has 10 rupees of earnings, has usually sold for 15, at the highest level sold at 18, lowest level sold at maybe 10. Okay, why did it sell at a high valuation? Why did it sell at a lower valuation? Things of that sort, and just look at a range of values and say, what, 3-4 years may roughly mota moti, it would give this kind of earnings, maybe would do this kind of valuation. Can I be sure? Like, there's a lot of energy which goes into it, right? What will be the valuation in 2028? And then you kind of work backwards and you tie yourself into knots, and okay, will it be 35? Will it be 32? Way too much of precision. If something at a rough this is not making sense, then there's no point in getting into this high level of pressure. It is not going to work out. And by the way, I'm not telling you from an academic point of view. I've done the whole analysis, I put the numbers, and I was telling you, right, I keep notes and records starting right from 2000, and I have companies where I'd said, this is my both at the individual stock level and at the portfolio level. I said, this is the EPS, this is the valuation which I expect 3 years from now. And then when I look at it 3 years later, it is like night and day. Something which I did not expect to do well went up like a rocket. Something which I expected to do well is still stuck at the same number. So repeatedly this kept happening, and then I realized, has importance, but it's way too much of, I mean, does not require too much of precision. Again, right, avoid all kinds of dogmatic thinking. By this time, I think this was firmly in my head that you should adapt. You shouldn't keep complaining, oh, I lost money because of this person and that person, or this happened, or this promoter did this, or that promoter did this. No, nobody is coming and forcing you to invest, right? So it's your mistake if you end up buying something and the promoter or the management does something which is bad, right? So anyway, that's part and parcel of of investing. And then again continue to make new mistakes and a few old ones, and I'll quickly talk through those, right? Let me pause here, Rishmoit. Let's see if people have questions. I have a few case studies to talk about.
Sure, sir. So
After
I'll
this.
just open the round for Q&A. First, I'll just lower all the hands. Then I'll just ask them to raise the hands again, because बहुत लोगों ने पहले से ही raise करे होते हैं. So, okay, now you can raise your hands. Awesome. First question we'll take from Siddhant K. Right. Awesome, sir. So, yes, Siddhant, your line has been unmuted.
Yeah, am I audible?
Right, you're audible, Siddhant.
Yeah. Sir, first of all, thank you for the opportunity. So my question is, like you highlighted that the first 2 years you had no readers. So what kept you motivated, sir?
I mean, I just like to write, right? So I was thinking of my blog as just something which I was writing for myself, and it was just like an online place where it's like instead of writing on a Word document on my own laptop, I was just posting it on the internet. That's all I was doing. It was more around my own notes, which I could go back and I can refer, right? So I've always done that so that, I think over time I've realized that if you write, if you want to really evolve as an investor, you should write and you should make notes. It doesn't matter where you do it and how you do it, because it's very easy to forget why you did something at a certain point of time. Right? Maybe even today I'm maybe the only one who actually looks at my own blog for posts which I've written in 2006 and 7, and then you realize, oh, this is how I was thinking about it, and this is what has changed. So that was the entire purpose. My own writing, just to keep a record, and if somebody reads, well and good. And I remember 3-4 people here and there would read, right, and no interest, but I kept writing because it was just my own records, that's all. So that was the only reason. No specific reason of why. So I used to write anyway on my own personal this thing. I just started posting about it. And by the way, the other benefit also is when you're writing in an open on a blog or something, you and this has become quite a bit, and I 100% subscribe to that point. People say you should write because it structures your thinking. I didn't think of it in that sense, but they're right. When you write for others and when you're writing in a structured manner, And when you know that some people, whether it's even 5 or whether it is 50 people, don't matter. When they are going to read it, you go through it again and you think through it, right? Is this making sense, what I'm writing? And then, you kind of think through it, you look through it, you analyze it. It just sharpens your thinking. And that was the only purpose. It was very purely selfish for my own learning, and it has helped my own learning quite a bit, because it makes you, think properly, write properly, explore your thoughts. So that was the entire reason, Siddhant. Only reason why I kept writing.
Thank you, sir.
I think there's a fantastic app which I use is by the name of Notes Joy, if anyone wants to use. And the thing is कि you can make these company threads. So like I've been like, suppose अगर 4 साल का company का thread बना हुआ है, every quarter I go and look at my own thoughts कि I was thinking this about the company and this has
Absolutely.
and it's actually fun to see कि what you were thinking and what turned out. Some of the times like you're bang on, and some of the times something else happens, the CEO resigns, something else happens.
Correct.
Like how wrong you can be. So it humbles you as well, and it's a very good way to sort of improve as an investor as well, actually.
Yeah. I mean, you stop doing some stuff which you realize you're wasting your time on, right? Like I was talking about the old DCF thing, right? I decided not to bore everyone with it. I started a spreadsheet in 2000 just to start putting stuff in, right? And then, first it had 10 tabs and it became 15 tabs. And at the height, it became like 85 tabs of analysis of a company. Okay, because every time I read a book and I think something is interesting, I'll adjust it. I'll do something. I'll put it in a tab as a checklist or something to analyze a company. But over time, I realized that, if you have an 80 tab worksheet for the company, a lot of times you drown in the detail, but you don't get the key points out of it. So you can put an 80 tab worksheet, but the key drivers are 3 maybe. So how do you realize that? If you keep notes and you keep writing, and then you look at what you were thinking at that time, and you see the result, and you realize that, I'm doing all of this stuff, but this is not where the value add was, and maybe something else is where the value add is, right?
Right.
So I think it's highly encouraged that you keep notes and you write. It doesn't take too long also.
100%. So like one of the companies I've been studying is like, again, the standard disclaimer, nothing's a recommendation or something, is Jubilant Ingrevia. And the company has multiple divisions, but one of the things that has been dictating the stock price, at least in the short term, is the inventory losses and inventory gain cycle of acetic acid.
Right.
That has been the case for at least last 8-9 years. If I just read the Jubilant Life Sciences business when it was a part of that one merged entity. So at least instead, if I go through 80-90 point checklist, so usse zyada sochne se acha, if I can just get to these 3-4 variables, whether it is getting into more specialty product, whether the margins will become more non-volatile, or whether this acetic acid issue might persist over a long period of time, and what are the prices of acetic acid today. So that might be much more useful than like drowning into details type.
Correct. Yep, you're right. Yeah, that's right.
So next question is from Mahesh S. So Mahesh S, I've unmuted your line. You can ask.
Sure. Thank you so much. Hope I'm audible.
Yes, you're audible, Mahesh.
Great. Thank you so much, Rohit sir, for the points you've shared. I have a bunch of questions, but I'll try to limit them. You sound very casual and very approachable, which is very admirable. I'm saying it in a positive sense. So my question is, did you always have a parallel source of income, which therefore you're able to keep a sort of a casual approach to investing? And if you had that all along, then did it act as an advantage to you so that you are humble and rational?
Yeah, and I actually have a slide on that. So just wait. That's a very, very important point. Yeah, so I actually have a slide and I'll talk through it. And the answer to your question is yes. There is, investing in the markets is stressful, and if this is your only source of income, I can again, same point, I brought it up earlier, right? All of us have different temperaments. There are people who can be invested 120% in the market, have this as their own sole source of income, and can be pretty calm and collected about it. And then there are some people who are chickens like me, right, who are like, Arey, what if this can go wrong and that can go wrong and this can go wrong? So we need, like, people like me need second, third, fourth level of margin of safety, right? So yeah, I think very important to know what is your mindset, and you will know that, right? If you lose sleep, again, I keep talking about it on my social media also, right? Sleep test. Is a company, is a certain allocation, is anything making you lose sleep? And if it is, right, that's a first sign your own mind is telling you, right, you're taking on too much which you can handle. So yeah,
Got it.
so yeah, so for me, I will not sleep well if if I'm not, so I kind of invest based on these very, non quantitative things. If something is going to make me miserable, I'm not going to do it, right? I mean, there's no
Got
point
it.
in being miserable. So yeah, so but I'll talk
Sure.
about it a little bit more. I have some suggestions, again, bond based on what I have done, right? And you have to always understand in terms of, a context of an individual, right? So just as an example, right, we, Mr. One of the biggest investors in India, Mr. Jhunjhunwala, right? He passed away, and there are these videos which talk about how he invested, right? And he said, right, he put all his money in Sisa Goa, right? But think of it, right? You can think of it in both ways, right? You can think, Array, there were 10 people who put money in Sisa, in whatever company XYZ, 100%, 9 went bust, but 1% kind of made it. So, there is this survivorship bias. So that is true. But also think of it this way, that majority cannot even do it, right? Like, I could never, forget about learning or envying, but I could never ever put all my money in one company and, wherever it went, right? So, very
True.
different, risk, very different temperament. So it's not just analysis, right? A gentleman like him, what gets underappreciated is, like, he had a iron, stomach to buy these stocks and then hold it, right? So I don't, and I do, I would never do it. So I'm fairly well diversified, and, in all sense of the way. And again, comes back from my own personal experiences. So yeah, so long answer to a
Sure.
short question.
Sure. Thank you, sir. Sir, I have one more, and then if you also have covered this in the slides, then I'll be happy to wait. But my question is, I'm new to investing journey, and currently what I'm
Right.
struggling with is, after I go through multiple annual reports and con calls
Mhm.
and blog posts, etc.
Mhm.
I get a lot of information, but I'm unable to conclude. I get lost in a bunch of sea of insights. So,
Mm.
do you follow any specific approach or framework to collate information
You're
which is
not,
only
is that
relevant?
something not limited to you? Happens
Okay.
to all of us. If somebody,
Okay.
you have to be very, if you think you have read everything and you've all figured it out now, then you know what, any investor, I again, based on my own personal experience, very rarely after reading all the annual reports and everything, you'll get an epiphany. And one thing, and I've just very briefly touched upon in the presentation, but very important for all of us to understand is, markets are smart, right? And it's not like, markets are dumb and they have not figured it out. I think that is something which took me a long time to hammer it into my head. It's not like a company is selling at 20 times, so the market is dumb and you are the only genius who knows, oh, this company should be 40 times. No, it's not like that. Actually, and markets have become more and more efficient. Like, how many people do we have, Ishmoit, on this call?
Almost 600 right now.
600, right? So 600 people on a Sunday evening learning from Ishmohit and many more, right? That is adding to market efficiency, right? 2005, if one person was there reading my blog, that was a phenomenal thing, right? So a lot of people doing a lot of hard work, and really digging into a company. So market is getting it right? So when you read through it and you look at the company and you look at the stock price and you say, Array, I can't figure out what the market is getting wrong. It's that not something, which, you're missing. You're in the right place. What you can do, I can suggest, is after you read all of this in a company, right, have a simple template, right, which says, okay, what do I know about the company? Okay, what are its, like, key points, right? Okay, what is the story behind it? What are the key competitive advantages? What is about the management? Just a simple, like after reading everything, just write everything down on a Word document. 1 page, 2 page, 5 page, whatever it is, doesn't matter. What it will do is, it will allow you to digest, synthesize, and put all of that in paper. So, when you read, what you realize is that, you read a lot of these things and there are all these dots all over the place, right? But you're saying you're not able to connect them, right? First, just write it down, right? That's all. First summary. Second, create a mind map, right? You guys understand, what is a mind map, right, Mahesh? It's like you just right. So just create a mind map.
Not
You can
really,
just
sir.
Google that term. Go into Google. You can just create a mind map.
Okay.
It says, different. Same thing. What you've written, you have drawn, right? Just create a mind map, and then after you read all of this, right, you don't have to come to a conclusion immediately. Just mull over it, leave it. I follow a simple like a thumb rule, both for my subscribers as for myself. I'll read about a company. I won't do anything about it immediately. I never do. I leave it at that time. Then I will come back to it after a few days, few weeks, something. And then again, I will come back. So even when I start a position, it will be a small position. I don't jump saying, oh, you know what, I've understood everything. I know all the dots. Okay. In my own personal experience, I've never been able to figure out a company completely in the first shot. It takes multiple iterations to go through it. So I'll read about it, understand it, make notes about it. If I really think I'm really confident I'm able to figure out, I'll still create a smaller position. And then what, after read about it again, hear from others, update your notes, create a mind map. It's an iterative process. Now, if the stock runs up, okay, it runs up, right? It runs away. But it takes time, right, to understand and build understanding of a company. Over time, what happens is you get these, these frameworks in your head where you can start slotting them. Again, that takes time. Some people can do it quickly. It took me much longer then. And then new things keep coming up, right? Some new business model will come up, some new sector will come up. So it's it's part of the process, Mahesh. Nothing nothing to all of us go through it at all times.
Got it. Thank you so much.
So, sir, I'll just take. I think, sir, we have time, right? So, Dipesh,
Yeah.
Unmuted your line, so you can ask the question. Dipesh Bajaj, are you there? I've unmuted your line.
Yeah, can you hear me?
Yeah, we can hear you.
Hey, thanks, Yashwant, and thanks, Rohit, for the wonderful presentation. It's very insightful. So what I wanted to understand, right, in the initial 10 years, right, you mentioned that you were doing a lot of mistakes also, right? I mean, over the time you learned. And at some point of time, you made this as a career also, and I believe so, right? And now you are in full-time investing only. So my question is, the first 10 years, right? That is the most difficult part, to keep ourselves motivated, right? We are losing money and we are also initial investor right now, right? We started our journey. But the thing is, there is a job which we do, right? And that job is also handsomely paid. And this market is also lucrative to us. We wanted to break through here, but it requires a lot of patience, a lot of hard work, right? How to keep ourselves motivated during this period, during this initial period. I know in the long term it is rewarding, but during the initial period it is very, very struggling, right? With the job in hand, right? Second question is, when you have an inflection point, right? When you decide that now you have to move from the job to the full-time investing and of this other career, right? What are your thoughts and how you made that decision? If you can put the light on these things, it will be great. Thanks.
I mean, again, I'm not going to disclose too much on a personal level on this forum, and as a matter of fact, on any forum. So, but let me try to address some of your points, Dipesh, and actually some of these points I have actually brought it up on the slides also. And these are very important points, right, which all of us will face, right? The first part about how do you keep yourself motivated? That's a little bit of a tough one, because what. And that's what I'm going to talk about actually in a slide in the coming this one. If you do investing only for the money, right, it's very tough to sustain it. I can tell you that, because there will be periods where it will be tough, painful, and I actually will address this. It's a very tough way to make money. I'm telling you from personal experience. A full-time job, I don't know about a business because I've not run a business in that sense, but I can tell you a full-time job is an easier way to make money. I can assure you that. Markets are brutal. They require constant learning. when you're working, let's say in any sector, any industry or something, you can learn a skill in the first 2 years, and then that's it. You can coast along for the next 3, 5, 7 years, right? For example, right, if you know Python, if you know you knew Java in the early 2000, you could live with it for 5, 7, 8 years, right? If you're in the software space. I'm just taking that as an example. I know not everybody is a software engineer. It doesn't work in the stock market. You learn something in a year, within 2 years, it becomes obsolete. So there are a few things you have to ask yourself. Am I in for the money or am I in for the interest? And you will know that answer soon, right? Because you will lose interest over time. And there's no harm in it. And I'm actually going to address this point in one of the subsequent slides. So no harm in it. That answer will come to you. Okay. In terms of time, yes, there is always, and I know some of you folks are very young. So initially, you will have more time, but when you have families, when you have kids, other responsibilities, but think of it this way: if this is really your interest and your passion, does it really matter whether you do 2 hours or 20 hours, right? Do whatever time you find, right? If you find 1 hour a day, okay, that is good. If you find 20 hours a day, then that is good, right? You will find the time, because if something is really your interest, you will find time here and there. Whether you make big money, good money, small money, doesn't matter. If you really love doing it, I can tell you, looking back, most of the people who have stuck around are people who end up doing it because they want to do it for the sake of it and not because of the money. The money will come. Money will come in other ways also. All of you guys are smart. You've learned enough about investing. You'll make a decent amount of money. So there's no easy formula. I think it comes down to your own personal interest. If you really love doing this, learning, analyzing companies, it will come through it. Why I suggest having an additional source of income during this initial phase: it is stressful in terms of time, but then the counterpoint is you don't have to depend on the stock market, on your portfolio for an income. So there is, if you have other sources of income, that is fantastic. If that is work, that is other sources through your family or something, that is good enough. Initially, just depending on the market is putting too much stress on it, right? It's like asking a small child to make an earning, right? You allow your child to grow up, study, get to college, and then you start earning, right? A small child cannot earn, right? I mean, forget about the laws and everything. Nobody wants child labor, but I'm just making an example out of an example in this case, taking example. So yeah, initially, don't look at it as something to make returns, something where you're investing your time in it, right? And then later on, obviously, I think when you get confident, you think, okay, you know what? Again, making a living, I'll try to bring this point up. Making a living only through full-time investing is not an easy thing, right? It happens much more later in life, right? When you have accumulated a lot of capital, right, and the returns will take care of your return of your spending. Earlier in the career, doesn't make sense unless you want to become a professional investor, wherein you're also selling your services, right? Which means you're doing then you're working in a different way, right? Investing for your own self versus running an advisory, running a fund, running anything else is a business in itself. It's just a different form of work, if you may. And that's maybe Ishmohit is a much better he can talk to you guys about it, right? It's a lot of work, right? It's not it doesn't happen a few hours a day. So hopefully, Dinesh, and I'll address some of the points later also in the slide, Dinesh.
Sure, Rohit, sir. And one question, right? When you decided to move to the full-time job, right? This investing job, what were the thoughts, right? And how you decided? If you can put it in later slide, also good.
I mean, see, I've always invested, whatever spare time I've had, I've kind of put that into investing, right? So my time, effort, energy kind of goes on this one on the side outside my work hours, right? So I've always done that. But at the same time, the numbers are very easy to run, right? You just have to model in terms of what your expenses are, what returns can you make. It's actually not very difficult to figure out. It's just that it's a very volatile form of income. You have to keep that in mind. It's not a steady income. It's like any other business. If you run right, there will be ups and downs. So obviously, you can always do, it's like the standard financial planning. Think of it like a semi-retirement, right? It's not retirement. From a financial standpoint, think of it like a retirement. You have X capital, you can withdraw so much amount, and that is all there is to it, right? So think of this in terms of like retirement planning, but not strictly like retirement planning. So when somebody retires, what do they do, right? They have a certain corpus, they put that money, it is invested across a set of assets, and they have a withdrawal rate, right? So what is the only difference if you're going into full-time investing? Only difference is, instead of that money going into mutual funds and fixed deposits and something, you are doing that investing, right? So, and why are you doing that investing? Because you think instead of the market giving you 15%, you will be able to do 20%, right? And can you do 20%? That there should be two parts to it, right? One, look very objectively at your returns and at least 10 to 12 years of returns at a minimum, 2 bear cycles, because everybody can make money during bull markets, right? So 2 extended bear cycles, right? Not a 2020 was not a bear cycle. 2020 was a blip, went down, came up, everybody was happy. A bear cycle is like, oh, it keeps going on and on, 2, 3, 4 years, right? That's a bear cycle. So if you ever go down that path, you should try to model that, right? If my portfolio goes through a 3-year bear cycle, 4-year bear cycle, where even if I do better than the market, right, it's very difficult not to lose money. How will I manage my finances? How will I take care of everything else, right? So you have to assume those scenarios, right? That if the market doesn't do very well for an extended period of time, how will you manage through it? And if that happens, if the numbers are still working out, then you should go ahead. But think a worst case scenario. Don't think about the years when you have done well. Think about 2, 3 years when again, I'm giving you a very cautious approach. It may not be the right one. Sometimes you should just jump into it. But anyway, I think that's how I would think about it.
Sure, sir. Thanks a lot.
Sure, sir. I think we should go ahead with the presentation, sir.
I think good questions, and actually, I've actually brought these points up. So we'll talk a little bit more about it. So let's talk about a few case studies, right? And I think you guys keep hearing about that a company is a movie and it's not a snapshot. And I'll share one movie with you, right? And how I got it wrong, because it's there is more learning from mistakes than there is from success, right? I mean, what do you don't learn much from success, because often success comes from luck also, right? So I'll talk about a company called Pyramid Enterprises. This company, very old, 25 plus year old company. They sold their domestic pharmaceutical business to Abbott, and they got quite a good valuation. I think they sold it at around 9 times sales or something like that, and they got quite a good valuation out of it. So the company was selling for, and they had a mishmash of a few small businesses which were left, but they were selling more or less for cash or slightly over cash in 2011. So I again, I had the advisory going on at that time, so I picked this particular stock up as a Graham style pick at that point of time, right? And then again, was holding it at that point, and then over that period, from 2011 onwards, Mr. Ajay Piramal, he made quite a few savvy investments. He invested that surplus cash into Vodafone. Some of that money he also rewarded the shareholders, through a special dividend. During that period from 2011 onwards, right, they had always been in the pharma business. So they got into CDMO, they got into some of their other current businesses which you're looking at. Right, they started getting into that. They started scaling that business. But what they did at that point of time was they got into financial services, and the financial services business took off, right? And in their financial services business, they were lending into real estate, mostly to developers, right? Again, in the wholesale segment, in the real estate segment, where your loans are big to developers, you can grow your book very quickly. So that is what they did, right? They lent a lot of money to developers and to builders, and they showed quite some steady growth, good dividends, rising stock price. So again, I had been holding it from 2011. So I'm talking of this period from 11 to almost 17, 18, 6, 7 years, right? Good steady growth, rising dividends, rising stock prices. So again, my confidence in the management kept increasing, knew that they were invested in the, in the real estate segment. They had, put money with, with the builders, but I felt, okay, they can manage the risk, right? And this is what happened, right? I've just taken the chart, buy it around 2011 as a cash bargain, around this time period. They sell a stake in Vodafone, they start scaling up financial services. And this is the period when, you see this is the vertical takeoff when they, when there is a lot of euphoria around financial services. And by the way, just to be clear, right? As Ishmoit has been saying, right? Not a recommendation, not a this. I'm just sharing this for, from a case study perspective. When I bought this, there was no grand vision that I had, oh, they will get into financial services and there a boom will come. Nothing of that sort. I just bought it because I liked the management. It was a cash bargain. And then just kept holding as they kept, as they kept executing. And then, this is the parabolic stage when, the stock took off because the, the financial services business was doing exceedingly well, right? So again, it's a movie, right? Starts as a cash bargain. And then, the management, the market, even in spite of 25 years of, good history behind it, keep in mind, this is 2011, right? So none of it has, the management has never gone outside pharma, right? And they sell their pharma business at a very high valuation. They don't, as it happens often with companies which sell their major businesses for cash, markets really dislike it because they don't know what management will do with this cash, right? Not so with the case with, Mr. Ajay Piramal. He rewarded the shareholders and started investing money into financial services and pharma, right? So again, no special insight. I just kept holding it. They executed, right? Stock is up, what, 6-7 times, maybe more. And then, obviously, this is a well-known, crash which came from 2008, right? They had invested in the real estate segment, right? 2018, October, the real, the ILFS crisis happens. The lending market kind of, has a almost like a stop, right? Market becomes extremely risk averse, starts looking at, at the lending book because of ILFS. Obviously builders are not able to get loans. The real estate market has anyway been in a 7 or 8 year, downtrend, and with this liquidity squeezing, right, it gets even worse. So obviously, stock for all these companies, including Piramal, which is heavily, weighted into the real estate segment, it starts getting hit, right? So again, you can see here a very painful drop, right? I sold out, as part of our advisory, we sold out somewhere, in 19, somewhere around 19 on the way down, right? A very painful experience, obviously, for me and, all my subscribers. But again, I said the same thing, right? Skin in the game. So whatever, my subscribers are losing, I am also losing the same thing. So the pain is felt equally. So the learnings were, obviously, why I said a change in the movie, right? It's a movie, right? Starts as a cash bargain, gets into pharma, gets into financial services. The financial services business takes off, right? So it's not the same company. The company in 2016 is not the same company in 2011. And the company in 2018 is not the same company as 2016 and 15, right? It usually does not happen this dramatically with most companies. But, I brought this up because, you can see, right? If you were thinking that this is the same company as 2011, it's not, right? 2018, the company was a very different company compared to what it was, let's say, in 14 or 15. I kind of miss that, right? That's what happens when, you get lulled into a sense of security after a good run, right? That's when you should be cautious, right? Another learning was, as I was telling you, right? A lot of math, a lot of mumbo jumbo I would do. So, did a lot of detailed analysis, look through their, their lending book, and I evaluated how much loss they can have. And they were selling roughly around, let's say, 40-50,000 crores market cap. And even today, the total losses out of all their book and everything are a few thousand crores, right? Maybe 3,000-4,000 crores or 5,000 crores, whatever that would be, right? I don't have the exact number. And look at the loss in the market cap, right? You'd say, oh, that's so disproportionate, but that's how markets are, right? Once markets lose confidence, the valuations will drop, right? So if you say the company is going to lose just 200 crores, why is the company dropping 2,000 crores, right? That's because, in the end, it's all valuation is more a confidence kind of a evaluation, right? When the market has confidence, it will give you a high valuation, right? Because it thinks you can keep growing consistently, you can manage the risk and everything. But when they get these surprises, right, valuations will drop, and these drops will exceed the losses by multiple times. So at that point of time, sitting and doing a math, what I've realized from my own learning is counterproductive, right? There is no math to it at that point of time. If you think, what, the market doesn't matter what you think also, right? You may think, oh, what, eventually they'll right the ship and they'll fix it, and you can see that partly from the stock, right? From the chart, right? The stock went down, and then obviously there are certain other issues, but they've kind of fixed some of it and it's coming along. But look at the right from 2017, 5 years, right, goes down and then comes back, right? A lot of opportunity loss. So key learning is that obviously if the valuations are high and the market has a lot of confidence in it, and if that confidence is broken, the losses can be severe. So very important to to see the whole thing as a movie which is changing, and then not to get stuck in that old narrative, right? The narrative is changing. So during that 2000, in the last 5 years, again, a lot of learnings, right? I invested both, and it's there on with obviously all my subscribers know it, and I don't have any. I know a lot of people now try to make fun about Edelweiss and Piramal, and they say, what, people who invested in that lost money. And but I never get upset about it, because but that's part of the game, right? I mean, everyone will make mistakes. You might as well just learn about it, don't repeat it, and you'll find some new ones to do, right? So again, my mistake was what I missed the evolution and changes in these companies over time, right? I also got swept up by market euphoria, and I broke my rule from 2001. So I said, right, never get stuck in the fad. So what I have avoided is, once something becomes a fad, I've avoided jumping into it, right? But what I missed over here was what I had already held before it became a fad, and it went into a fad, right? Or it went into a crazy bull run. I kind of slowly got pulled into it, right? I didn't realize my bargains and my stock were actually now becoming very we're becoming the darlings of the market, right? And I should get cautious. I didn't make that switch, right? Again, realize psychology is more important than numbers, right? You can do whatever math you want, but the markets do tend to discount future risks much better. So just keep always that in mind. And finally, when you make a mistake, right, don't blame it on others, right? Don't blame it on the market, don't blame it on ILFS, don't blame it on management or anything, right? Blame yourself first, learn, right, and then move on, right? And obviously, if somebody makes fun of the mistake, or somebody points it out, I mean, that's it, take it and move on, right? I mean, that's how it is. So I'm just summarizing this, right? I've already spoken a lot about it, right? What's the evolution and learning, right? And again, I won't go too much again, but this is again, this is all in hindsight, right? And hopefully a lot more learnings which will happen in the future, right? A quick touch upon 2020, right? I got quite cautious about it in 2020, and why was that? I remember writing this on my blog, sharing it also, and I always think in terms of scenarios now, right? And when the market crashed, I was thinking about 2008. I was thinking, do I know what's going to happen? And very honestly, at any point of time, I don't know what is going to happen, right? And so does nobody else, right? So people will say, war in Ukraine, oil is going to go here, and this would happen with inflation and all of that. The reality is nobody knows, right? So at that point of time, I didn't know whether the market was going to recover. I didn't know whether it will recover so quickly. It could, right? And that was the upside risk, as they call it, right? Or it could get worse, right? So at that point of time, my thinking was, worst case scenario, if this market drags on and on for the next 2 to 3 years, right? Can you sustain that, right? You go all in at the bottom of the market, and what if it just keeps dragging like 2008, takes 8, 9, 12 months? And if you really look at the history, there have been periods of time, like in the 70s in the US, and in the 30s in the US, and that's another important thing, read history, right? Just because something is happening now, does not mean you will it will happen something based on the recent past, right? There are other scenarios which should play out from from way back, right? So my thought process, what happens if the market remains, or does not keep going down, right? Bear markets don't mean that they just keep going down. Often the markets will correct and then they will just sit there, for the next 2 to 3 years, and they will sap all your energy, go up and down and up and down. And it happened in from 99 to 2002, right? 3 years of like just grinding markets, right? Plus 5%, plus 10%, down 10%, right? So what if that happens, right? So I didn't want to risk putting all my money in and then just painfully watch it, right? But turned out to be wrong. The market went down, and then the Fed just came in, and then obviously the RBI also came in, and they flooded money into the market, and markets went parabolic, right? So they went parabolic in India. They went even they went even higher in the US and in all the other global markets. But that was the risk assessment I did, that it's better to be cautious in getting back, and that's always been the case, right? Again, not right or wrong, based on my own experiences. So that's the thing, right? Markets change, we have to adapt, manage the risk, right? That you have to live to to see another day, and opportunities will come, right? So no need to get carried away. So let's talk about my stock selection process, right? And Ishmael, just let me know about time, right? If we have a hard stop at any point, we can do that also.
Sure, sir.
Yeah. So I have just a couple of slides left. I'll quickly go through that, right? So in terms of the stock selection process, right? Again, active investing does not, what means is that the market is not pricing the known facts, right? So you always keep that in mind, right? Assume the market is a good, is efficient, knows what it is doing. So you're trying to find out something which is mispriced, right? Used to use quantitative screens a lot till 2010. Not very useful now, right? I mean, why have I used the word complex adaptive systems? That's basically a term which is where any system or any structure where it is constantly adapting, and that is what markets are, right? If something starts making money, everybody will do it, and then that will not work in the future, right? So how do I do it now, right? I was saying, right, I would watch something which Ishmohit has put, somebody has published certain reports, right? I will run a certain screen, right? Like there's an earnings beat, there's a price spike, right? No specific formulas for it, right? And the first thing which I will do is I will look at the last 5-10 years of history. We were just talking about it through a question, right? Look at last 5-10 years of history, try to understand the big picture. Is there a theme behind the company? Run a checklist to see, is there something which is totally, wrong about the company, which, I should just stop wasting my time further. If none of this, then, start asking questions, right? Ask, why is the company mispriced? Like, why is this such a, why am I able to figure out something which all the other intelligent folks are not able to figure out, right? Like, why is the company getting mispriced? Why I'm the lucky person who knows about it and not the market, right? So anyway, a quick case study for it, right? So mid 2020, right after the COVID crisis, or during the COVID crisis, actually, Lotus Labs, right? It reports a sudden spike in profits in June 2020 and September 2020 after years of patchy results, right? So I started asking the question, right? Well, like, why is that happening, right? You can see from the numbers. And what caught my eye was that, the spike was phenomenal, right? Like, from 17, 60, 100 crores, it suddenly became 159, right? Like when such huge spikes happen, you have to look at it. Often it is, some material shortage, some supply shortage, some very, short-term commodity price increase, and the company just makes a lot of money for 1 or 2 quarters, and then that's the end of the story. So you have to check that. This was not a company in that kind of a sector, right? It's in the pharmaceutical space, right? So I looked at last 5-10 years of history, right? Tried to understand the big picture, as to what had changed. And what I saw that, the company was seeing an inflection in the generic, fixed dosage form. And I'm not going to go into detail. I think Ishmohit has covered this talk with all of you folks, right? If I'm not mistaken. But what I saw was that, their generic FDF, business, which had been working on all the ARVs, had gained traction, right? So, the mental model which comes over here is this bamboo shoot mental model, right? I think you may have heard of it, right? How does bamboo grow, right? It will keep growing below the ground for a very extended period of time, and you'll see nothing coming out of the ground, right? For a long period of time. And then suddenly it bursts out of the ground. And then within a matter of a few weeks, it grows into like multiple feet, right? So it's like a lot of work going on for a very long time. and then the results are suddenly seen. This is just suddenly like an inflection. So it's not like Laurus management suddenly woke up in Q1 or Q2 of 2020 or something like that, and then started selling a lot. They had been working for for years together, and then there was an inflection. So I saw this inflection come in, right? And then obviously you could see that the company a company started delivering results, and then there was business momentum, and then obviously there's a stock momentum also, right? Now so by the time it comes to last year, right, again another kind of a thought process or a mental model. I always think of companies, right? Think of companies which are growing very rapidly like a rocket, right? You have all these tanks in the rocket, right, which are firing, right? And that's how the rocket keeps gaining altitude, right? But at some point one tank will finish, right? I mean, it will get over, right? And then for the company or the rocket to keep moving forward, another engine has to fire, right? Another fuel tank has to fire. Otherwise, forget about the gravity part of it. But otherwise the what will happen to the rocket, right? It'll just float around in space, right? It'll just maintain that orbit or whatever you want to call it, right? Not a perfect analogy, but think of it that way, right? So for it to continue to get altitude, another engine has to fire, right? Now what was happening in this case was the generic FDF is not providing additional growth, right? It is doing well, but it is not providing that extra boost. And then the new engines, CDMO and bio, their bio acquisition has yet to provide enough additional thrust. So the company will kind of do okay, right? But for it to continue going up, it needs the new engines to fire, right? Where this mental model also helps is if the old engine is not going to provide any additional thrust, then the whole thing can even come crashing down. Luckily in this case, their generic FDF still continuing to make the same amount of money, but the new growth triggers have not come in. So again, two options, right? You wait for the transition and you continue to hold, and you can see that, right? This is the time when that is happening. Or you exit and you monitor till the new engine kicks in, right? Now in the past, I would just buy and hold, and I would just sit around and wait. But I've paid a little bit of a price in terms of holding it, following buy and hold as a religion. So in this case, we moved out, right? Again, again, not a recommendation, not a suggestion also for anyone. But I still continue to monitor the companies, the same thing which had come up, right? And again, a very good company, management is doing the right things, their CDMO is doing well and all that stuff. And then it if when the new engines fire, right, and the old ones continue to fire at the same rate, same thing, right? Think of it like the rocket. It will gain new altitude and the stock price will also follow, right? So anyway, that's one very quick case study of again, a lot of work went behind it, right? But I'm trying to just distill it down to the few points. Right now, again, you can have an 80 tab checklist like mine, but finally the crux will come down to a few variables which will drive it. Another case study, I'll go through it quickly. Makes sense not to just share what has worked, right? Always makes sense to also share what has not worked, right? Same scenario, right? Inflection due to higher health API and FDFs, right? Same thing happened over here. Stock goes up like this, right? And then what happened? The improvement turned out to be a little bit temporary. A lot of other issues happened, right? The existing management, right? The CEO of the company changed. The company was also has a big business in Turkey. Turkey is under macro stress, and then obviously the supply chain challenges because of which the API business got impacted in the terms of what raw material prices that they were not able to pass through. Now remember, both these positions, or just as a disclosure, we held it in our advisory, but they were almost at the same time as Laurus Labs, both of them, right? I took action in Laurus Labs but did not do anything, right? I just sat on it, and this gain kind of turned into a loss, right? So the learning is that two parts, right? One is behavior, at least in my case, it's not always consistent, right? In this case, I was still trying to rationalize it. I thought this is temporary, whereas for some reason I took a decision with Laurus Labs but didn't do that with with Sequent, right? So again, markets are brutal. You will pay a price for not making a decision. So so anyway, so this was a very similar case, right? Few variables kind of figured it out, but the did not take the decision at the right point of time. And by the way, you see this particular screen. What another way of how I track what I am doing, right? The green star which you have seen is when I've bought something. I keep these notes, right? Then I'll put a red star when I sell something, and then you see this blue in this circle. This blue is when I should have done something and I didn't do it, right? So this will now remains when I pull up this chart, maybe 1 year, 2 years, 3 years down the road. I've done that for most of the companies. I'll have a green if I've bought something, red if I've sold something. If I didn't do anything and I should have done something in hindsight, then I'll put a blue check mark, right? So it's a good reminder, right? Like, and I'll keep some notes also, right? Saying, okay, what I should have done. So again, same thing, right? So quick one on mistakes, right? Very important, right? To keep in mind that mistakes, the best of us makes mistakes. If you make if you get it right 60 to 70% of the time, that's very lucky with that. It's not a multiple choice exam, right? So if if you get it right, it matters in terms of how much you make when you get it right. And you would have heard that quite often, right? Stock goes up 10x, and you have a 5% position, it will it'll add to 50% in terms of your portfolio, right? How much max can you lose? 5%, right? So it's very asymmetric, right? The question is how much you get it, how much you make when you get it right versus when you get it wrong, right? So always think portfolio returns, right? Not stock returns. Very important, right? But they never make a mistake which knocks you out of the game, right? So don't go for leverage, don't go for too much concentration, and don't go for options and futures. Something which destroys your confidence, that's very important. More than money, I would say it's confidence when you're starting early, right? Because if your confidence gets down, money will, unless you get into excessive debt or something, you can usually manage the money part of it. It's the confidence part of it, and which knocks you off the game far more, right? A lot of people lose a lot of money and then they just kind of just give up, right? They never come back to the markets, and they lose and they give it up so much that they never even invest in index funds or even mutual funds. They just stop investing in the stock market, and that is what that does more damage than having lost that money in a specific stock. So I know most of you would not be in that bucket, but still always keep that in mind, right? Don't go bust. I think there was a question on this, right? It came up, right? Like how did I make that switch and all of that? And this is the slide I was talking about. You have to ask yourself, why are you really investing, right? I know we all say that we are doing it for the money, right? But you have to ask beyond that, right? Are you just doing it for the money, right? Because that's a tough one, right? You can do that for a few years, but you can't do that for a very long time, right? So again, some questions or some things which make sense for me at least, right? And each one of us will have different answers to it. I do it obviously for for growing my capital at an above average rate, but also at a low risk, right? And a lot of people don't think about it. For me, this has been also about gaining financial independence, right? So it's not just that I want to make money for money's sake. Improves my quality of life and gives me freedom of choice. And a very important part is the intellectual challenge, right? I know all of you are in this particular call to learn and to learn from Ishmohit and others. So that's a very big important part of it. And then I get to talk and meet a lot of new and very interesting people. A lot of my friends and even people like Ishmohit and others, I've met them through this, right? Through this activity, very different from from all the other things which happen. So it keeps you mentally active, agile, right? Engaged. It's very important, right? This I put a link for this post, and this was a question about somebody asked, should I invest, how should I make a transition to full-time investing? And this is quite a bit of a chart, and I'll just take a minute over here, but think of ROI on your time and your not just money, right? I mean, in the end, let's say you're working full-time, right? And that is what this post talks about. I'd written it way back in 2019. And this was a time when the market had been going up and everybody keeps talking about, I want to become a full-time investor and all that, right? But what I did in this chart is I took a example, just for the, I've just put some numbers in, but I said, what if you are working full time, right? I just took just more of a thought experiment, right? Let's say you are making 10 lakhs per year. That's the example I took, and you're saving 50%. So what do? You save 5 lakhs, right? And let's say you did nothing, right? Like you just took that money and just dropped it into an index, right? So what will be your return? 5.7 lakhs, right? Let's say you're a super investor, and I know 22% sometimes sounds to be, too low, but believe me, the 22% over a 30-year period is a big good number. Let's even take 25 if you want to get really, aggressive about it. So what I did was, okay, what is it? What will your savings become if you do that? And this is the delta you are getting. So what I'm saying is, see, you should not think of your returns as what you're making as a, from a full-time or from an active investing. You should think of it, what is the extra I am making over and above what I would make if I did nothing, right? Like, any one of us, right? We could take all our money and we can just go ahead and put it in mutual funds and index funds, and we'll make something, right? It's not like it's a zero or something, right? So by investing actively, you're making a delta. What I'm trying to do over here, and ignore the time part of it. What I'm trying to do over here is I'm saying, this is the extra returns in terms of dollars or rupees or whatever currency, you're making. So in terms of per hour of time which you have put, and you can put whatever time you actually use, you put on investing into per hour, right? And you're saying, this is what you're making as a salary from investing. And this is what you're making, as, whatever you're making from your current job. And I looked at a range of scenarios, and what I realized was that, in the initial part of your career, or, for quite some time, till your corpus becomes big enough, what you earn from your salary cannot match what you will get delta by investing actively. Like it takes a good amount of time to accumulate money, to start earning. And by the way, you can see this, right? It's a very nice, smooth upward, right? Never happens that way, right? There'll be bad years, there'll be good years also. Compounding will get broken. So this was more to say, think about it, about ROI on your time, right? Is doing full-time job good? Do you really hate your job? Is there something you need to do differently, right? Is investing that thing, or you're just trying to get away from the job and do this, So this was more a mathematical way of doing it. I'll just stop here for a minute, Ishmael, if somebody has a question on this or some of the earlier slides.
Sure, sir. I'll just open the chat section. I'll just lower all the hands, and I'll like you can raise all the hands again, because some of the times pehle ka hand raise kara hota hai, so I just unmute the line and no one asks a question. So first I've lowered the hands. Now you can raise all the hands again. Cool. So I'll first take the question from Amandeep Singh. Amandeep, I've unmuted your line. You can ask your question. Hi, Amandeep.
Hello.
Ask
Hi, can you hear me?
Yeah, you're audible.
Thank you. Rohit, I wanted to ask, how do you mentioned about how you deal with FOMO? It's something similar. So there are narratives all around, right? Right now there are narratives on capex cycle and other stuff. Last year it was chemical. So how do you deal with it, right? Because when the example you took 10 years back, social media was not there, right? But now whenever you open your laptop or media, you have all these information coming, right? So how do you filter this out, and how you can selectively use it to your advantage?
Right. It's always tough, Amandeep. So one is, the first thing is, I used to have this very standard thumb rule. I will avoid fads and all that, right? But it becomes too restrictive, right? It should not be that, every time some people, like when I still remember when these discussions happened around chemicals in 2017, 18 maybe, and some people even send me these research reports. I said, oh, this looks like a fad. Close your mind, move on, right? And it didn't turn out to be a 1 year, 2 year fad. It has turned out to be a decent theme. So what I will start is, I will say, okay, you know what? There is some element of truth behind it. Like let's give that, right? Not everybody is dumb. The market is not dumb. So read about it, right? Like the first thing you do is, do not have a conclusion. Do not make up your mind, right? Which is what another thing, right? The thing with some thumb rules will always hold, right? Don't go into leverage. There's no fad around it, right? Like don't go into leverage, period, right? So we'll keep that part aside. But these things, you know what? just keep an open mind. Somebody recommends a stock which is 100 times earning. Somebody says, a capex cycle is turning. Take that stuff up, start reading, right? The good thing about social media and all of this is you'll get a lot of, reports and all of that stuff, right? Just read about it, right? Like try to understand what is going on, but also read the history. So like, for example, the capex cycle is going up now, right? But it happened earlier also. It happened early 2000s, right? And then there was a crash. So try to review the history and see where do we stand in the history, right? Are you getting all of this, at the later part of the whole cycle? Are you getting it at the early part? And if you can't even arrive at a conclusion, that is fine. Pick up a few stocks here and there and make some token investment so that you start tracking it, you start learning about it, right? There's no right or wrong answer, right? You don't have to just always ignore all that is coming in, but learn to read it, absorb it, and at least follow it, right? Like give it some time to form your own thought, right? When you get all this information, right, you think you are you will assume that, what, I've read it and I've understood it and I've formed my own thoughts. But most of the times, you're not forming your own thoughts. All that is happening is you're taking the information in and you have not done enough critical thinking. So the key word is critical thinking, right? Get all this stuff in, read, write about it, mull over it, form your own opinions, right? And then maybe after a couple of months, when things cool down and you're not as much, into the, you're not primed as much, then you can start making this. And if the market runs away at that time or those stocks run away, then that's okay, right? If there is still value, if it's a, let's say for capex cycle, it's a 7-year cycle. I'm just making this up, right? Let's say it will run for the next 6 years. How does it matter if you catch it a year late, right? If you figure it out and everything. And let's say if it was just a year, a 1.5 or 2 year cycle, and if you finally at a year later you realize that, what, this cycle is getting overheated, then you just dodged a bullet, right? Then you don't need to get into it. So just figure out, right, how long this will run, form your own opinions around it, and then if you get in a little bit late, then that's also fine, right? Rather than getting at the peak or something.
Thank you, Rohit. This helps. If Ishmoit allows, I have one more question. Ishmoit?
Sure, ask, feel free.
Okay. So Rohit wanted to, do you invest in special situations? If yes, how do you
used
filter?
to. Yeah,
Okay.
I used to. I stopped it. Again, two reasons. One is, and I just do it on and off here and there. Two reasons, right? One is this special situations also started off as a small piece, few people were doing, and then maybe same point again, I'm come back to, right? Markets are efficient. People, once an opportunity comes, a lot of people will move in, and then you have to think of the same thing, or return on your time invested. So what happened was, the return started going down, and a lot of people came in, right? So then it became, the whole return on my time became, a pretty low, right? I mean, it required too much time and effort, and so I kind of stopped doing it. So I do it on and off here and there, but the returns and the risk returns, kind of, the equation kind of, just was not good enough. And usually I think the reason why it's time consuming is because you have to kind of keep reading the filings every day, and you have to follow it and all that. And it's a good way if you're an active investor and you're doing this quite some time. But and you bring up a good question. I've always felt that I have to figure out the best possible use of my time, given whatever X number of hours I can devote to investing, right? So let's say you're working full time and you have a family and all of that other stuff, right? Wife and kids and all that. You have to figure out, okay, where am I going to allocate this limited time? So it kind of comes to that, right? That and if you have a full-time job also, that maybe then special situations are not the right place if you're short of time. But yeah, if you're an active investor, professional investor, then definitely good place.
Thank you, Rohit. Thank you.
Yeah.
I think one more thing to the first question was, like, suppose we talked about capex cycle and stuff, is that there are always higher beta plays and lower beta plays. Like higher beta play will be something like an EPC company if you're looking at to play the capex cycle.
Right.
The capex cycle has to come for the EPC company to make money, right? Now, the lower beta stuff will be the proxies. Now, suppose there are cable and wire companies, which is just providing industrial cables. And if you just
Right.
look at the volume growth guidances, is like 18-20% volume growth guidances. And even if the capex cycle hasn't been there in the last 5 years, still it's growing volumes at 18-20%. So that's just a lower beta play if the capex comes in. So that will just be an added cherry on the top. So it's just a way of looking at things. But I think, as rightly mentioned, we can't just write off all narratives as narratives. At least we should take a look at them, because again, then we get into labeling. Ki yaar, ye to narrative hai. Then that labeling will actually see. Problem with act of omission is, suppose if you miss out on 1 6 or 7 bagger type stock, so, and suppose if you have 2 stocks, one goes down by 50% and the other one goes up by like 4 or 5 bagger, then the joy of 4 or 5 bagger or the gain on a portfolio level will be much higher as compared to the loss that will make. So I think nothing should be counted out as a narrative. At least it should be a given serious thought, because I have also done this mistake a lot of times कि मेरे को लगता है यार ये तो narrative है, इसको कौन पढ़ेगा. But फिर जाके जब पढ़ता हूँ, then I've actually found a lot of stuff. Like these days I'm reading this hotel sector. I've never even thought कि I'll read the hotel sector, even though I might not invest, but at least it will give me a thought process how to think about the hotel sector if I ever want to invest. Right.
Correct. Yeah, I mean, yeah, keeping an open mind, and you one of the things which I said, right, you have to understand what is the theme which is going on. When I was giving you the example of Lotus Labs, right? So there's a very good book, I think, by Ashwath Damodaran, Narratives and Numbers. I think you should all of you guys should read that, right? And that's one of the other learnings I talk about, right? A lot of us are engineers, or a lot of are very quantitative in our thinking, and we kind of underestimate the importance of narratives. I mean, narratives are very important. End of the day, valuation is what? It's a narrative, right? The number is only there, and one company could have the same earnings as others, but would have a much higher valuation. So it's very important, right? You read it, learn about it, and then you can always make up your mind later. So keep an open mind.
So like suppose there's this EPC company, PSP projects. If I just give you the financials of that company, and if I just give you the financials of Asian Paints, and if I just don't even tell you the name of the company, and if I just give you the ROC and the working capital,
exactly, yep,
and the return ratios, you won't be able to differentiate whether which one's the EPC company or the paints company.
Yeah, that's
only when the narrative gets added on top, then the valuation gets adjusted.
Correct.
So I think, sir, we'll take the next question. I think, sir, we'll have a stop at 9 p.m. I think till then schedule.
Yeah, let's do that.
So Mohit, I'm unmuting your line. You can ask a question. Yeah, Mohit, your line is unmuted. Mohit, you can ask a question.
Okay, hi. Mohit, can you hear me now?
Yeah, you're audible.
Okay. Hi, Rohit. My question is very straightforward and simple. Given the fact that you have been in 25 years and now you have a service also that you provide, so how many stocks do you have in your portfolio? And do you limit them, or you say, okay, this is my buy and hold, and this is my kind of I would move in and out. So is there a formula for that as well?
Not really a formula. I generally keep it around 18 to 20, because usually if you even see the academic research, and it kind of works to that your ideal kind of, by experience also, you'll see the same thing, and you'll see it over here also. 15-17 stocks are usually good enough from an adequate diversification standpoint. So I'm a big proponent of diversification and risk management, right? So again, 15 stocks, all stocks in let's say in the power sector will not be diversification. Right? I'm making again an extreme example. So I'm constantly thinking, okay, am I diversified enough? So it's the number of stocks, number of sectors. And I know we don't have enough time to now talk, but you also need to think about what are the variables driving those particular so the two examples I had, right, Piramal and Edelweiss, different businesses, but they appear to be they ended up being correlated, right? So you may think one is in pharma and the other is in financial services, but they ended up being driven by the financial services sector cycle, right? Everybody completely ignored the pharma side of the business. So number of stocks is a you can have a certain number of stocks, but you have to think not number of stocks, but in terms of diversification. Am I adequately diversified across sectors, across drivers? And obviously, and then sometimes, even 10 or 12 stocks will work, or sometimes 18 to 20, whatever, again, same thing, whatever makes you comfortable. Don't overdo it on the either sides. People talk of five stock portfolios because Buffett does it. There's only one Buffett and only one Charlie Munger, right? I mean, I'm not that guy by even by like within light years also, right? So that would be a completely dumb way of thinking in my own personal case, right? So I think a good thumb rule is assume that you are not smart, right? And diversify adequately. And then if you turn out to be smarter than what you were thinking earlier, then nothing is stopping you from getting more and more concentrated. So that's how I think about it. It's a derivative of diversification and risk management than anything else. Again, no standard formulas. There aren't any, at least. For 15, 16 is usually good enough. Like you can go up and
Right,
down.
and would cash be a component on that?
Yeah,
Would
cash
you,
always is again, a component of, again, I keep coming back to the same point, right? It's, it's what allows me to sleep well in night, right? So there are times when, cash has gone down to, a low single digit, a couple of percentage points. And then, obviously when valuations are very high, it's more counter-cyclical. When valuations are very high and, everything is getting euphoric and I can't find anything, my cash keeps going up. So again, no target levels. It's all very subjective, no specific formula. And again, as a personal investor, my, you mentioned, right? And I say that, right? Even though I run an advisory, my advisory is based on my personal portfolio. If it doesn't make sense for me, I don't do it, right? So there's no mandate for me to say I have to be fully invested. I don't give a damn about that. If I'm not going to put all my money in, then why should I tell anybody to put all their money in, right? So if I'm not comfortable with being 100% invested, I'll keep more in cash. When I feel comfortable, and I say, okay, valuations make sense, and I can find good enough ideas, I'll go more. I'll reduce the cash levels. So it kind of follows that.
Sure. Thank you so much.
No problem.
Thanks, Ishmael.
Okay, thank you. So, sir, we'll just take one last question before we resume. So we have 40 minutes, so we have time. So we'll take one last question from Arshdeep Singh's side. So Arshdeep, I've unmuted your line. You can ask your question.
Can you hear me now?
Yeah, go ahead.
I think your voice is a bit feeble.
Hello, Rohit sir. Thank you for sharing the valuable lessons with us. Sir, as you mentioned before that few stocks that as the market is very unpredictable, and the few stocks that you well researched, but they went down with a loss, and the other stocks went multi-bagger, and you waited for the 3 years like in Lotus Labs, and the result was not good. So at that point, what to do? As we invested in a well-researched stock for 3 years, but it went nowhere. So what should be the next step? Should we wait for 1 more year, or just get our money out and invest in somewhere?
Right. Again, no, very, I mean, Lotus Labs was not that one. It was more in the case of Sequent. Lotus, we exited. So again, there's no bright line which says, this is when you should do it, right? I have been guilty of both. I have sold things early, and this will happen, no matter what you do, right? We have to just get comfortable with it that, sometimes you will hold longer than you should have. And then sometimes, you would sell too early, right? And if you agonize too much over it, then, it's pointless, right? Usually what I've seen is that, after 2 years, if you don't see the stock moving anywhere and the management comes and gives you a new reason every other time, right? Then just move on, right? Whatever loss or profit you have, just move on, right? So do something called as a pre-mortem, right? I think, what a pre-mortem is, when you start buying, you think of, okay, now I am kind of moving, like, let's say 2022, I am buying this stock. 2024, I'm now looking at this stock at that point of time. What could have gone wrong in this? And you say, okay, you know what? This could have gone wrong. That could have gone wrong. Some of this would not work. Make a note of all of that, right? Also think of, okay, what should work for this stock to do well, right? And then start tracking to that. Like, you'll have smaller milestones. You can say, my management has said this is by 2023. this will happen, then 2024 this will happen, and then when you get closer to 2023, see whether that is all playing out or not, right? Or is the goalpost constantly moving? And which is where I usually think of, investing in a graded format, right? You don't go full position in, right? Very rarely do I find something which is undervalued, firing on all cylinders, giving good numbers, right? Like, why will you find such a position, right? Like, everybody else is also looking at it, right? So usually it's, same thing around a movie, right? The situation is evolving, new story is coming up. You see how the story is playing out. And if the story is not playing out, right, then a year and a half, 2 years down the road, give it some time. That at some time you'll have to pull the plug. Again, it's not a quantitative way of doing it. I have been guilty of holding stocks way too long because the story kept shifting, right? And there have been some companies where I have bought it, and then 2 quarters down the road, the management has one reason, and then again at 2 quarters there is another reason. When you see it happen once or twice, right, then just move on. So again, 2 years is a good enough time, but there's a lot of subjectivity in it also, right? You may sell it, and whatever the management was saying actually then happens 2 quarters later. You know what? Keep a note of it, right? And if you realize that, oh, you know what, I was a bit too early, bit too in a hurry to form a conclusion, and the management actually went and delivered what they were saying, then you change your mind and go and buy it back again, right? So I know it's not a very clear and a crisp answer, but it is messy to say the least, right? It is like, you'll go back and forth and you'll change your mind constantly, but that's okay, right? Investing only from outside appears to be very clean and I know narrative driven, and oh, you know what, I put these 5 points and it all laid out this way and this was the story, and it is nothing like that, right? Behind the scene, it is all a lot of running around and figuring out and scratching your head and going back and forth, right? So don't get taken in by the crisp reports which come out and the nice price targets and the media noise and the interviews and all of that. It's never that clean and easy. Everybody is confused and everybody's trying to figure it all out, right? That's how it is.
Sure, sir. I think let's go ahead with the presentation, sir. Right. Actually, like the perception of so I think your line got muted.
Yeah.
Right.
Ishmael, I'll also have to drop in the next 15 minutes.
Acha. So I think
so let me run through the presentation,
right.
a few slides, and then we can wrap up, right?
Sure. Done.
Yeah. So anyway, I think we've spoken a lot about this. I'm not going to repeat it again. Let me just quickly talk about a different topic. Poker, right? And I don't know how many of you kind of play this game, but it's a very interesting game. And I threw this slide in because this is a new interest which I've taken up in the last couple of years. And it's and I would highly encourage some of you guys, I mean, try this game out again. Don't take this up just because it will make you a better investor, or this is what investors should do. Don't do anything of that sort. But the game is very easy if you. It's simple but not easy in that sense. The rules are very straightforward, right? There are people sitting around a table, right? And everybody gets dealt 2 cards initially, right? And these cards are hidden. They are kept face down, right? And you get to look at your cards, right? And then I mean, I'm not going to go into all the details, but there's a round of betting and people look at their cards and they make their their judgments. And how does it work? After that, first 3 cards are put, and then after that one more card will open, another card will open, and after the first round, people do a round of betting based on when they look at their own hand, and then they will think about so this is the chart which you follow, right? If it is usually called as a best of 5, so you will look at the 2 cards in your hand and the 5 cards which get laid out over here, and you will pick the best 5 out of that, and whoever makes the best combination wins the pot which is being created over here. So let's say all cards get dealt out and one person gets, let's say something called as a straight, which is like 5 cards in a row, right? That person is the winner. He gets all the money which has gone in, right? Now again, for the purpose of our discussion, I would suggest just go ahead, Look it up. It's a very, it's a very simple and an interesting game. Does not require much to learn, and I'm sure a lot of you would be aware of it or may even be playing it. It's a very an interesting kind of a case study, or you can say a laboratory for decision making, right? It is different from investing, because in investing, as an example, there is no chart which tells you what will win, right? What wins today will not win tomorrow, right? But there are a lot of commonalities, right? It requires a working knowledge of probability and of estimating odds, right? So you're constantly doing that, right? Why? Because you know what, you have two cards which are hidden and which are face down, right? So you don't know what your opponents are holding, right? You're competing against all the other players on the table, right? So you are trying to guess, based on the cards which I have in my hand and which are there in front of me on the table, what is the hand I am making, right? Like, do I have two pairs? Do I have, this kind of a series? Do I have a, something called as a flush? But I'm also trying to guess what the others are holding, right? Do they have a better hand than me? So if that other person is betting, should I bet because I have a better hand than that person, or do I have a weaker hand than that person? So at any point of time, it's guess, right? You're guessing the odds, right? Based on how that person is betting, what information you are getting, is that person betting much higher than you? Is he or she trying to bluff you? So at all points of time, you are computing the odds. And then again, you don't know what cards are going to come up, right? You may start with two very good cards, and then three cards come and you improve on it, right? But then another fourth card comes, and it helps some opponent of yours, and they make a much stronger kind of, you call it, a hand compared to what you have, and that changes the odds completely, right? So whatever money you have put in, is gone down the drain because the odds have changed, right? So you're constantly looking at new information which is coming in. You're comparing the odds, right? And when the odds are in your favor, right, you bet more. And when the odds go against you, and how do you know the odds are going against you? The card is, you're not making any hand, right? Let's say some person started betting, and they're continuously increasing their bet, right? So none of your hand has been made. All that you have, let's say in this example, you have a king, right? You have a high king, right? And some person started off, and based on this layout, you see that they're continuously betting right now. Either they are bluffing or they have already made a strong hand. Like, let's say they have a 9-10 J king queen, whereas you only are holding a high pair or something like that. Then you know what, odds are not in your favor. You fold, right? And whatever money you have put it in the pot is gone, right? So it's very much like investing, right? You're constantly estimating the odds. You're looking at whether the odds are in your favor or not, and you fold when they are not, right? And you have to just close the hand in spite of, and sometimes the odds may be in your favor, but it still doesn't work out, right? And that is what happens with companies, right? You look at a company, odds are very good, everything is very promising, and everything, the company is doing very well. It's the travel business, market, people are traveling now, spending money, and then what happens? COVID comes, right? And what you think was a very good hand, cheap company, growing, doing very well, the wrong thing happened, and that entire sector went down, right? So it's something like that, right? It happens when you play this game. You see that the big difference is what, in investing it takes months and years for the results to play out. Here, what, the results within like 5 minutes at best, right? So it gives you a good working knowledge of, you develop this quick way of estimating the probabilities, estimating odds. You also learn risk management, right? If players who are very aggressive, they get bust out, right? Or they, basically they lose all the money which they've brought into that particular, session. So I would encourage you to, learn this game. And if you find it to be enjoyable, which I do, it's a social game also. It teaches you a lot about, about risk management. It teaches you about psychology. It teaches you about your own psychology. And you'll find fascinating parallels between, how people invest and how people play poker, right? A lot of people are very optimistic. A lot of people are very, very conservative, and obviously the key always is to know when you have to be optimistic and aggressive versus when you have to be pessimistic, right? So, I would highly recommend, learn this game. If you like it, play it, but don't play it, just because you want to become a better investor. And that's not the, that's not the point. But, if you do, if you like it, I would, I would say, it would help in terms of thinking on these concepts. Right. So anyway, quick last few slides. What would I change if I was starting again, right? One is I would have, higher equity allocation earlier in life, right? Too conservative looking back, maybe it was not the right thing to do, but I think at least it allowed me to survive and just keep growing and keep evolving, right? One is another being patient and with valuations and consistent growth, right? So what I've realized is that the opportunity loss and opportunity losses are things which never appear, on in terms of numbers. These are losses which you kind of can estimate, but they are not there in your balance sheet or your P&L, right? So opportunity lost, I've kind of did a calculation. I realized that what I lost in selling Asian Paints, Pidilite, and Gujarat Gas would have covered all my losses till date, right? So very important. I think Ishmoit brought up this point, right? Something which you are not very sure about, create a small position, right? Start off a little bit with it. Who knows where it will take you, right? Sometimes the upside will be so much that being a little skeptical is okay, but not investing may not be a good option. And that, I think that is true when you're young and you're getting into equities, right? There's a huge element of opportunity, right? You in your early 20s, if you invest, you have a long runway ahead of you. True for companies, true for individuals also, right? So so that's important. Next is my own background is of an engineer, right? So I always looked at it as a math problem. I would say don't approach it too much like an engineer, right? There is a certain math to it, but that's that's the bare minimum, right? You don't have to get too fancy about it. Think more in terms of psychology and all other subjective aspects, compared to it, like an engineer. And then finally, don't be dogmatic, right? It's not like value investing is a superior or a better way to invest. There is a lot to learn from trading. There's a lot to learn from quantitative investing, and that's a topic in itself, right? We can always talk about, okay, what can you learn from a trader, right? And that's another thing. I think that question came up. What have I changed in the last 5 years, right? I used to ignore trading, quantitative investing completely in the past. I don't now. Does not mean I trade, or does not mean I do quantitative investing, right? I mean, for myself alone, does not mean I'll become a technical analyst. But you know what? It makes sense to learn. And the most important point is that these approaches to investing, whether it is trading or whether it is quants or whether it is momentum, they have been around, right? I mean, they've not gone away. So there is definitely something which they are doing right, correct? So the kind, what you have to do is, look at it and try to abstract, like, what are the elements which make them successful, right? Like, what is it about good traders, right? You will always hear, traders talk about risk management. Value investors don't talk much about risk management. They do. I mean, I'm not saying that, they are ignorant, but traders are constantly talking about taking losses, talking about, risk management. So that's a good topic to, to dive into and learn. And I've, been thinking a lot about it in the, in the recent past about it. Same way quantitative investing, right? Like, what is that one aspect of quantitative investing which you can abstract from it, right? It's basically saying that, investing based on these. So there are two learnings which I have taken from quantitative investing. One is that, use testable, kind of, assumptions or hypotheses, right? What does quantitative investing do very well, right? It does not go by, Rohit said this, Ishmoit said that, Warren Buffett did it. No, it'll say, what? Rohit is saying ABC is a superior way to invest. And, you will first try to quantify it. You'll say, okay, high ROCE gives higher returns. Is it true? And you will analyze and you will test it and you'll do all kind of back tests and everything. And you will build a bunch of rules, or you will build a bunch of, and end of the day, even value investing has its own rules also, right? It's not like, it's all art, right? So you'll build a bunch of rules and it will test. And it will then, implement those rules. And then, what, you will come back after some time and you will again retest and you'll see, do these rules hold true or not? So it's basically, the learning you can get from quant investing is that, do not go by hearsay, right? go by testable hypothesis, go by testable rules, and then follow those rules unemotionally, right? That is what quant investing is about. It's trying to get, trying to avoid behavioral biases by using these, these formulas, and having, formulas which have been tested and have been, proven based on it. Obviously, it has its own downsides and its own negatives, but these are the positives you can learn from it, and then you can kind of start thinking about it. And that's a completely different topic. I've been thinking of writing some of these things down, over my blog also. Maybe I will do that. But okay, what can you learn from trading, and how can you incorporate the learnings? I'm not saying you start doing day trading on an hourly basis or something like that, but there are elements of risk management which you can learn from them, and same thing you can do from a quantitative investing standpoint also. So that's what I've been doing. I've even been investigating momentum investing also. Does not mean I do momentum investing, but okay, what are the elements of momentum investing, right? That it's like the Newton's law, right? That if there is momentum in the business, it tends to last, and that same thing happens in the form of stock price also. So kind of respect that, right? That's how the markets work. Okay, what would I not change, right? This I said I would change, right? So never give up even when I get it wrong, right? Don't use leverage. What's the hurry, right? That's what I keep saying. Read, write, share, have some fun while you're investing, right? I mean, don't make it a drudgery, don't make it just work, right? And then it's not just about the money, right? Just kept saying that again and again, right? So this is what I would not change. So yes, this is where you can reach me at, right? This is my blog, this is the website, and my Twitter handle, which I have not put over here, is at the rate of Rohit Chauhan, right? Over to you, Ashmoy.
Right, sir. Thank you so much for the session, and hope to actually play virtually poker with you someday.
Yes, definitely.
Like abhi thoda Diwali season, so in Delhi we have this tradition, so like people play like teen patti and stuff, but I have like a lot of friends group, we play poker, and because we play poker, so it becomes a little fun as well, because money is also involved. Right.
Oh yeah, no. And teen patti is, I mean, that's how we started, right? Start with teen patti, and then we realize, oh, let's move on to poker. And oh, it's a very fun. I mean, I know I try to make a investing this thing around it. There are a lot of parallels, but yeah, it's a fun way to spend time also, no doubts.
Right, sir. Right. So I think, sir, with this we'll conclude the session, and recording for everyone who wants to come back and watch it again will be available in the SOIC membership, and for the like RC Capital members, I think Rohit Chauhan sir will make it available. And just in the chat section below, can we just drop a like thank you to Rohit Chauhan sir just in the chat section. I hope like a lot of your doubts were cleared, because a lot of working people are there in the session as well, and still there are like 350, 380 people who are still there in the session.
Thanks, Ishmoit, and thanks everyone. Thanks for having me on, and it was a real pleasure preparing and presenting to you. It's always useful to even look at your own experiences, because you also learn from it, right?
Awesome, sir. Awesome. Thank you so much, sir. Hope to keep and hope to keep having these sessions over and over again. And
definitely,
let's do something on some sector as well sometime in the future.
Sure, will do.
Sure, sir.
Thank you, Ishmoit. Thank you, everyone.
Bye. Everyone have a good Sunday night. Bye.
Thank you.